the market, right? And how many offers would I get on? Unbelievable. What did the world come to? Yeah, prices of houses were going up 27% in 1 year. Crazy market. Isn't this a fun business to be in? You say, okay, hold on to your seat, have fun, and off you go. And they send you down the roller coaster. Well, we're in a different market today. But it doesn't necessarily mean that it can't be just as fun. So things have changed. Well, what have changed? Well, of course, interest rates have gone up. And the United States bond market, US Treasury, just got rated by the Standard & Poor's and Moody and all those guys. And they decided that the US Treasury bond is close to a junk bond. So what's that going to do to interest rates? Well, of course, it's going to make them go way down, right? No, they're going to continue to go up. So we've got a lot of economic forces right now that are not looking all that positive. So we sit down with buyers, we sit down with sellers, and we try to present a very upbeat persona, don't we? Real estate is wonderful. No, it's not. Nonetheless, our job as realtors is to help people achieve their goals. Sellers still want to sell, buyers still need to buy, and so our job is to help bring those two parties together. Now, when I got into real estate, you can tell that I'm an old guy, interest rates were 18%. We did not take our buyers down to the local mortgage company and get them pre-qualified for a loan. Nobody got mortgages in 1980. But that didn't mean people still didn't need to sell their homes, and it still didn't mean, and it didn't mean that people needed to have a place to live. So in 1980, everything we did was seller financing. And that's how I cut my teeth in real estate, is I learned all the tools necessary to bring buyers and sellers together in a market where interest rates were outrageous. And that's what we're going to talk about today, is how to have extra tools in our toolbox to be able to achieve the goals of our buyers and sellers. And so, let's see, what's this slide about? Oh, this probably got names and phone numbers. This will come up at the end of the class as well, so you don't have to worry about writing it down right now. But there'll be 3 presenters. And we start at the bottom. There's me. I'm David Kenney. I'm a real estate broker, and I've been in real estate since 1980, which I just told you about. Okay? So I've been around a little bit. Frankly, I'm on the verge of retirement, which is a great thing. Then we're going to have George Andersen, who's a mortgage broker. And he's been in the business for 30 years, but he has a very unique skill set. He focuses on helping buyers and sellers who have gotten into seller financing contracts. So from the buyer's point of view, they want to be able to enter into a contract that they can successfully, at some point in the near future, refinance that contract and get a permanent loan. In addition, sellers want to know, well, okay, I just sold my house on seller financing. How does that affect my ability to get another mortgage on a house that I want to go buy? Because I don't want to be homeless just because I got into a seller financing contract. So George is going to talk extensively about the role of the lender in this process of seller financing. Now, I'm also going to mention at this point, George was responsible for the sandwiches. So when he comes up, you can say, thanks for the sandwiches, George. Okay, anyway. And then the last part of the class, we're going to have Jax Pettey come up and talk about the legal side of seller financing. Now, I can't tell you how many times I've called up a listing agent and said, hey, I've got a buyer that's interested in your house. Can I come and present an offer to you and your seller? What kind of a reception would I get to that kind of request? How would you respond if an agent called you and said, can I present an offer to you and your seller? And you're the listing agent.
Email it.
Yeah, email it. No, I actually want to sit down with you and the seller and present an offer. Well, back in 1980, that's the way we always did it. We would go and would sit down with the seller. We would explain our offer. Of course, the listing agent would be there. And then the listing agent would excuse us. We'd go sit in the car and let them discuss it. And sometimes they'd say, come back tomorrow. Other times they'd go, okay, come on back in. And then we would either counter or we'd figure out what we were going to do from there. But if I suggest such a thing today, it's like, what are you talking about? No, you can't talk to my seller. Is that the way we should react? Does the seller have a right to hear all offers? Yeah, actually they do. But nonetheless, I can't get past those listing agents. So finally I'll say, well, can I at least come and visit with you and explain the offer I've got? Well, okay. Why don't you just email? What kind of an offer? They don't want to get off the phone. In fact, it's very often that I can't even get them on the phone. I have to send a text or an email because this later generation, they're incredibly annoyed if you actually call them. What are you doing calling me? No. So, but nonetheless, as soon as I tell them, well, this is a seller financing offer. Here's a common response. Oh, we can't do those. Those are illegal. What? Where did you get that idea? Well, my seller has a mortgage on their property and there's a due on sale clause in their mortgage. So we can't do seller financing. Or I've heard that they're not illegal. So here's the long short of what I just point I want to make. Jax is going to talk for an hour and a half about the legal side of doing seller financing. It is 100% legal for a seller to be able to sell their home on seller financing. So we want to get that out of the way right up front. But there are things we want to do to make sure our contracts have proper disclosures, that they're legally prepared documents by attorneys, and that our buyers and sellers are actually protected and know the risks and the advantages and disadvantages of doing seller financing versus your traditional type sale, where you show up to the title company, sign papers, and you're done. You never see each other again. So that's where Jax comes in, okay? Now, let's jump in to the type of seller financing we typically see. Now, if I tell my seller, are you interested in looking at a seller financing offer? What do you think my response might be from a seller if I just throw that at them? No. Why would I do that? I want to sell my house. That's why I'm hiring you. Okay, well, that's great. But your house right now would appraise for $450,000. And their response, well, my neighbor sold his house a year and a half ago for $500,000. Yeah, well, that was a year and a half ago. Oh, that's depressing. Yeah. But I tell you what, I've got a buyer who would give you $500,000 for your house. Well, then let's do that. Can I actually sell that house for $500,000 or to somebody who is depending on getting a loan from a mortgage company if the house will only appraise for $450,000? What's the chances of me being able to complete that transaction? Yeah, that's right. So now, a year and a half ago, were people coming up with extra money if it didn't appraise? They were. Not today. Today, the buyers are saying, well, we qualify for a mortgage, and we want you, the seller, to pay our closing costs. Okay, and maybe even kick in a little bit to buy down our interest rate because we're qualified buyers. Are there people out there who can't qualify for mortgages?
Yes.
There's a lot of people. Well, if you can't qualify for a mortgage, you're not worthy of a house. Didn't you get the memo? That's not true, is it? There are a lot of people, a lot of different circumstances where the mortgage company may look at their situation and say, you don't qualify quite yet. There's this and this and this and that, and there's a lot of different underwriting, rules that people have to comply with that may make somebody not qualified today. Well, if that becomes the case, unfortunately, way too many people will just discard them and say, come back in a year or come back when you can qualify. Well, what if you didn't have to discard them? What if you said, well, okay, you can't qualify today, but according to your mortgage guy, if you do this and this and this, you can qualify in a year from now. So I go to my seller and I said, these people really like your house. They've got $50,000 they can put down. They've just been to a lender. They can get a loan from a mortgage company in 1 year. Would you be willing to look at an offer if the price that they gave you was $500,000 instead of $450,000? And now the seller's going, maybe. Tell me more. So is that practical? Is it possible that a buyer may be willing to pay 10% more for a house if the seller is willing to do seller financing? All the time, all the time. So here I'm now presenting something to a seller that will actually help them get more money for their house. And if the buyer can refinance in 1 year or 2 years or 3 years, whatever the time frame, what is the seller really doing with their seller financing contract? It's more like a bridge loan, isn't it? It's a temporary loan in which we're getting the buyer from today until they can qualify for a loan. Now, most of the time, we would typically call that a lease option because that's the kind of the fallback. If you can't qualify, well, maybe we can find somebody who would be willing to do a lease option. Well, that is one way to do seller financing is lease option, but there's other things that we can do as well. But nonetheless, that's typically what a seller financing contract will do, is it's typically a bridge type loan. Not necessarily. I have sellers all the time who look at the numbers and they go, wow, I've got a 2.5% mortgage. Anybody out there that has really low interest rates on their mortgages? Yeah, there's thousands of them. And you're telling me my buyer's willing to pay me 7%, which is current market rates? Let's do the math. That means I'm earning 24% return on my equity. How would they like to do a 30-year contract? And I see that quite frequently. Once the sellers find out what kind of rate of return they can make on the seller financing contract, all of a sudden they don't want the buyer to pay it off in 1 year. They would prefer to have a longer contract. So it doesn't necessarily have to be a bridge loan, okay? So then I take that seller and I say, well, okay, great, you sold my house. Can I go buy another house? And so we're going to talk about getting a bank involved in evaluating the seller situation or making sure that the contracts that we're using would meet an underwriter's guidelines to allow the seller to use the income from the contract we just got them into so they can qualify for their next mortgage, okay? And finally, we've already talked, we're going to look at how the law looks at seller financing. So the three types of seller financing: a lease option, which everybody's familiar with. How many of you love to do lease options? I don't see a lot of hands going up. Maybe it's because you may not ever get paid. And I get that. I'm not all that excited about doing lease options either, although there is a place for them. I do want to make a mention of the fact that one of the more exciting things about a lease option, if I'm a buyer with a lease option and I've had that option, say, for 3 or 4 years, and my option is coming due, and I look at the option that says I have the right to buy this house that I'm in for $400,000. And today it's worth $525,000. And so I'm scrambling as the buyer, and I go down to the mortgage company and said, I've got 2 months left on my option. Can you get me a loan? And the lender looks at it and goes, I wish we could, but you've got this problem and this problem and this problem. So no, I can't get you a loan. So then where's the buyer? What options do they have at that point? Maybe private money, that's a good one. What do most tenants think that their options are? None. They're going, oh, I put $10,000 down on my option. What's going to happen to my $10,000? You're going to lose it. Is the landlord going to be unhappy with the fact that you lost your $10,000? No, in fact, he's going, well, please don't refinance. Please don't refinance. Please leave so I can take the house back and sell it and make a whole bunch more money. Well, here's the beauty of a lease option that most tenants don't know. If you have a lease option, you can sell the option. It's legal for you to sell the option. Now, you can't necessarily sell the lease without the landlord's permission, but you have every right to sell the option. That's something we as realtors need to know. So if we have somebody come to us and they're into that situation, we can offer them other options. I buy lease options all the time. People will call me up and say, Dave, I heard that my realtor was in your class. I understand you buy options. I said, yeah, tell me about your situation. Well, we put $10,000 down, and here's my situation. I said, I will give you your $10,000 back, and I will give you another $20,000 cash to buy your option. Is that a better scenario than the other one they were faced with?
Is it in the contract?
It doesn't have to be in the contract that they can sell the option. Anybody who has an option has a legal contract that they have the option to buy that house, which means they can sell that legal contract to somebody else who would then exercise that option. Okay?
What if it says non-transferable? Is that?
Most of them aren't. Most of them, but there's even a way around that too. So wait, what I do is I will have them show up at closing. I will provide them with the money to buy the house, and then they immediately give me title and I give them their money. So it's kind of like private finance you talked about, okay? But the important part there is the contractor, the people who have the option, they have other things they can do besides just handing the keys back and walking away. So an option can be a very powerful tool for our clients if they actually have a great option to buy a house. Any questions about that? Yes.
So how about if there was have a credit score is really low and then is that on the lease option? Is it able if buying is not US citizen or something?
Yeah, there's all sorts of scenarios where somebody can't get a mortgage.
Yeah, can
And if they have a lease option, yeah, that's a possible gift. But if you're getting somebody into a lease option, what is the end goal? For them to be able to eventually get a mortgage and be able to exercise that option and buy out the landlord, right? Okay. Well, that's the true with the seller financing type contracts too. Okay. But those are the type of people that are very often our best customers. People who have immigration issues are some of my best customers. Okay. Well, there's another type of seller financing. It's called a contract for deed. Now, this type of contract has been around forever. It's not something Jax Pettey made up. Okay. Every single state in the country has this kind of contract. And what this is I'm entering into a contract to buy the house, not lease it, to buy the house between me and the seller. We've entered into a contract. And the seller will give me titles to the house once I've paid off the contract. So the big difference in this type of contract is I don't get title to the house until I've paid off the contract. Thus the name contract for deed. Okay. This type of contract is referred to in all of the underlying underwriting guidelines, FHA, VA, conventional, Fannie Mae, Freddie Mac. If I buy a house using a contract for deed, I can take that contract to a lender and it specifically says that I can refinance it even though I'm not on title. So I'm actually buying the house. I have what's called equitable title. Okay, so I'm not renting, I'm buying the house. Okay. Now, the third common type of seller financing contract is an all-inclusive trust deed. Now, this assumes that there is an underlying, yes, question on that.
How much the buyer should put down for that?
For the contract for deed? Okay, that's a good question. If I look at my closing cost for my seller, 6% for those evil real estate agents, title insurance, settlement fees, I start adding that up, I'm going, I can't take a 5% down payment from the buyer, otherwise I'm coming up with money out of pocket to close. So from a practical point of view, I tell people minimum of 10% down. Okay. But whatever you want to negotiate, it's negotiable. There's no set absolute on how much the down payment. Okay, let's get back to here. So my seller has a mortgage on the house. We're not going to pay that off. The buyer's going to give me a down payment. I, as the seller, I'm going to transfer title to the buyer. Use warranty deed, and I'm stipulating that warranty deed. It's subject to the underlying mortgage because I'm not going to pay it off. So I can't warrant that it's free and clear of all liens because there's an underlying mortgage that's thus the name all inclusive. It includes the fact that there's underlying liens on the property. So I'm going to record a trust deed to secure my interest in the property, just like a mortgage company records a trust deed. Okay. So yes, question.
So if they do an all-inclusive trust deed, are the sellers still able to go and buy a different house?
That's a very good question. And we've got to do that carefully. And the way I do that is if that's the way we're going to end up doing the contract, I actually use a combination of the lease option and the all-inclusive. I will do a lease option for a period of time so that the underwriter can use 75% of the payment for the seller to qualify for their next house. Once they've closed on their next house, then I come back and we close on the all-inclusive trust deed. Otherwise, if I do this first, then the underwriter has to use 100% of the debt on the mortgage as part of their debt to income ratio. Okay. So yeah, there's some ways to get the seller to achieve their objectives if we know how to use these different kinds of contracts. Good question. Yeah, he wanted to know if you do an all-inclusive trust deed, can the seller get another mortgage? Yes.
So what if the seller doesn't have an underlying mortgage? What's the best option?
Okay, if the seller owns the house free and clear, then you take off this part. It's no longer all-inclusive. It's just a trust deed and note, just like a mortgage company does. Okay, and I've had sellers in that
Yeah,
situation.
I have one under contract with seller finance right now, just like that.
Yeah.
That's what ours is working at. I just want to make sure.
That's exactly right. And there's some big advantages to a seller for doing this. I had a client who owned a fourplex down in Salt Lake. So well, if I sell it outright, I'm going to have $500,000 of capital gains that I'll have to pay taxes all in 1 year. And so, well, let's sell it on seller financing. So we did. And because it's a seller financing contract, they get to spread the tax liability over the life of the contract. So they only pay taxes on money that they receive in the year that they receive. And that's called a installment sale. Now the IRS gives you the option though. You can choose to take the entire gain in the year you sell it. Or you can use the installment method and spread the tax liability over the life of the contract. So there are some really good reasons why somebody who owns the house free and clear would be thrilled to do a seller financing contract rather than being cashed out. Okay? Any other questions? Yes.
With the 1937 law, you can waive $500,000.
Well, if it's been my primary residence, absolutely. If it's been my primary residence, I have up to $500,000 tax-free of gain if I'm married. If I'm single, it's up to $250,000 tax-free. Yes, question.
So if someone's doing a contract for deed, let's say they're an investor, do they still receive those tax benefits that come with? Let's say
The contract for deed can be used as a installment sale. Closing on a contract for deed is the taxable event.
But if, let's say they don't close, like during that remainder of the time period, do the investor, do they receive those tax benefits?
In terms of the $500,000,
Yeah. Like
no,
just-
you have to be primary residence
Okay,
in order to have that $500,000 tax-free gain. It has to be your residence, and I have to live there 2 out of the last 5 years.
so you would only get the benefits after you close on the property.
Well, if it's my house and I've lived there 2 out of the last 5 years, and I sell it on a contract for deed, the day I close the contract for deed is the taxable event. And I have up to $500,000 tax-free, even though I haven't received all my money yet. I may not get all my money for 4 or 5 years down the road. And when I get all my money, I don't have to pay taxes on it because I already dealt with that when I closed on it.
What about someone on the other side of the buyer who's maybe buying it as an investment? They don't receive those taxes.
Yeah, well, it's purchase.
Gotcha.
One of the things that you have to realize is that when I do seller financing, the only difference between that kind of a transaction and me getting a loan from the bank is the seller's the bank. Everything else is exactly the same. Okay?
So the 2 to 5 years, that could be the first two, it doesn't matter which.
No,
year.
it doesn't have to be consecutive.
Okay.
I could live there for the first year, rent it for 3 years, and live there for the last year,
Doesn't matter.
or any combination.
Okay, and then the second question, we said the same, so they're, if you're seller finance, it's still tax deductible, their interest.
Seller financing contract, if I'm receiving interest on that contract, I have to pay taxes on the interest. It's the capital gain that I'm looking at in terms of being tax-free. So if I bought my house for $200,000 and I sell it for $500,000, I have a $300,000 gain. That's all tax-free. So again, if I'm sitting down with a seller and I'm saying, okay, I know your house will only appraise for $450,000, but if you're willing to sell it or sell it on seller financing, I can get $500,000 for it. And by the way, that extra $50,000 is 100% tax-free. And the sellers are going, why don't more people do this? And that is a common response that I get when I'm explaining the advantage of seller financing to a seller. Okay, any other questions? Yes.
So that 75%, talking about if they're receiving rent, right? And then
Right.
they're getting another loan. Does that have to be seasoned for a year?
No, they can do it immediately. So if I'm selling and my seller needs to get another mortgage, I want to present something to the underwriter that says lease on it. Not a contract for deed, not an all-inclusive trust deed. Okay, and George is going to talk about a special document that they put together that meets those criteria. And that way the seller can count 75% of the payment to offset their mortgage, which is a big advantage in them being able to get another loan. Okay, any other questions? We're throwing a lot of information out here, aren't we? All right, let's continue.
Mr. Kenney,
Yes,
so when you sold it, that the day that you have a tax free.
the day I close on my contract is the taxable event.
And then, they make payment. Are those tax free?
No, well, any principal portion is tax-free. Any interest, I have to pay taxes on it. That's legitimate taxable income. Okay, now I get to deduct any interest that I'm paying on my underlying mortgage. So I don't have to pay 100% taxes on the full interest my buyer gives me because I have an interest payment from my underlying mortgage. So I subtract that from the interest I'm getting from my buyer, and I only pay taxes on the difference. Okay,
And the buyer gets the tax.
yeah,
advantage.
buyer gets tax advantage too. They're buying a house. And by the way, you're going to have this contract go through an escrow company. So the buyer's going to make payments to an escrow company. The escrow company keeps track of all the accounting. And at the end of the year, they send the proper tax documents to the IRS and to the buyer and the seller. So it feels just like any other mortgage
It's 1099 to the seller. And
That's right.
1098 to the.
buyer and to the IRS. So the IRS knows as well. Okay? All right, any other questions? Good questions.
I have a question.
Oh, I'll ask the question. Go ahead.
And in regards to the
75%, right?
Rental income or lease income. whatever.
Right.
Does this apply towards the mortgage payment?
Yes.
Or to the income of the?
No, the mortgage payment. It's an offset to the mortgage payment. Right. And that's a very good point, because if it was just added to their income, that's not necessarily gonna resolve the debt to income ratio.
I had a situation like that, and the lender said that it will be added to their income. Say, no, it's better if it's applied to the-
Then you need to get a different lender. You should have used George. No.
Well, I don't know your.
I know, okay. So, based on all these questions, I'm gonna give you a little warning. Today, we're covering this on seller financing. There is so much more to go over on seller financing, and it can be an incredibly exciting topic. One of the big things I do right now with seller financing is I work with old people like me who have retirement accounts, and they use their Roth IRAs and their other retirement accounts to buy real estate. And it becomes tax-free type money. So there's exciting things that can be done with seller financing. The reason why they have to use seller financing is because I can't go get a loan with my Roth IRA. Because it can't be, it has to be a non-recourse type loan. Well, I can do that with the seller, but most mortgage companies won't touch me. And so if I want to buy a house with my Roth IRA, I can do that with seller financing. And then people say, what about 1031 exchanges? Yes, you can do a 1031 exchange using seller financing. I don't know how many of you do 1031 exchange, but I've had buyers come to me and say, Dave, I just sold my house, my rental property. I've got $200,000 sitting with my administrator. And I just found out I can't qualify for a mortgage. How do I complete my 1031 exchange? We'll find your house on seller financing. Wouldn't it be nice for me to present to a seller, Mr. Seller, I've got a buyer who's got $200,000 they want to put down on your $450,000 house. Would you consider a seller financing contract? Yeah, absolutely. I would consider a seller financing contract. So you can use seller financing to complete a 1031 exchange. How about fix and flips? Yeah. Don't use hard money, use seller financing. So there's a whole bunch of different applications for seller financing that we ought to have in our toolbox to help our buyers and sellers. So unfortunately, we can't cover it all because we're short on time. Okay, so I'm going to have George come up for a few minutes. And he's going to talk to us about the role of the lender. So George Andersen, come on up. He's the one that provided our sandwiches. Here's your little one. There it is. Okay, so how many people that are here for the CE class? Oh, because nobody can hear me. Oh, it's because of that. Well, now I'm gonna be nervous. See, I already fumbled. Where did it go, right about there? That works. Okay. Okay, so hey, Susie. Robin. And I know some more people. I'm sorry, I'm like the worst. I have 7 kids. I stumble with my kids. So just Dave. Okay, so anyway, how many people that are here were at like the 1 hour kind of like compressed little thing that we did over at KW? Okay, so
Okay, so a lot of you are getting this information. How many people are here getting this class for the first time? Okay, this is good. All right. So you'll notice on there that there's some additional classes and stuff like that, because everybody always asks, we want more information, So there's some stuff that we put out, some information on YouTube. Anybody can go on there and they can look at it. And then Dave does some really intense training with this stuff that I would recommend taking a look at that. And then I just have a part that I do. I do like a 1 hour Zoom class that goes over some real live case scenario stuff where you're going to run into these situations if you're doing seller finance, because the last thing you want to do on seller finance deal is represent the buyer who's putting down 50 grand, maybe 60 grand. And for most of these people, okay, is this just casual money that they just have laying around, or is this their life savings that they're putting into a house? It's their life savings that they're putting into a house, okay? And the seller says, yeah, I'm okay with seller finance, but I need to be cashed out in 2 years. Well, the buyer talked to his brother-in-law that used to be in the mortgage business 13 years ago, and he said he should be fine. There's nothing you can't fix in 2 years. So the buyer on that premise goes ahead and puts down the 50 grand for $60,000. And then 2 years comes by and they go and try to refinance the house, and they find out that they can't because maybe they had a foreclosure or something else, or maybe they've never filed a tax return. Nobody would ever do that, but. Okay. Okay. So, but anyway, but the point is though, is that, I mean, if you're representing the buyer and you allow them to put down that money, okay, and thing goes bad, okay, what's the likelihood that they come back and point some fingers at you for that? I mean, you have some responsibility, right, as a buyer's agent, to make sure that your buyer isn't, doing something that's going to mess them up, especially if you got a short window, 1 or 2 year balloon on it. It's not a good thing. On the same side of it, the seller, okay, now, are there sellers out there that can sell their house and not get all of their equity, qualify for 2 mortgage payments and get into another house? There are. But you know what? The same people that are those people, they're also smart enough to know that why do I want to give up my $400,000 mortgage at 3% and get a $600,000 mortgage at 7%? They're also smart enough to know that too, which is why, anybody listen to Stuart Barney on Fox? You know what he calls all the sellers that have got a low interest rate mortgage? 40% of the mortgages in the United States right now are below 4%. He calls it the golden handcuffs. Right? Because their sellers, would they sell if they thought they could trade up and keep the same rate? Yeah, they do it, right? So that's one of the reasons we don't have so much inventory. So anyway, so just a couple of things on here that if you're kind of doing a do-it-yourself seller finance without working with a good agent, a lender, and a title company that knows how to structure the contract, you have some problems you can run into. The number one thing, if you're doing a contract for deed, the underwriting guidelines have changed over the course. Me and Jax and Dave got this course approved, and it was Jax's idea, and then Jax just let Dave and I come along for the ride. So like, we were happy, we're like, we were flattered, but Dave has done hundreds of transactions, seller finance. I have done dozens. Jax has done thousands. Okay, so that's kind of why you have the group that you have here as far as the instructors on this. And I'm not, and I mean, that means not only financing them, but also just personally involved, investing and doing it as well. And there's some real mistakes that can be made on here if this is kind of like a do-it-yourself type thing. And the number one thing is that this did not used to be a requirement, but FHA changed the guidelines, and it also changed the Fannie Mae Freddie Mac. Now, this was quite a while ago, but the notice of interest on the contract for deed has to be reported. On the state of Utah's website, okay, you can go, or no, it's corporation, no, real estate.utah.gov. Yeah, so it's real on the real estate division's website, you can click on there and there's state approved forms. And one of the forms that's a state approved form is a uniform real estate contract. Has anybody ever seen that on there? Uniform real estate contract. It's a state approved form. Attorneys have looked at it. They've said, yeah, it's good enough. We'll put it on the state's website. That functions as a contract for deed. The problem with the uniform real estate contract is that that is a Utah only term. We're the only state that calls it that. In Arizona, they call it an agreement for sale. In the southern states, they call it a bond for deed. In California, they call it a land contract. But the most common term is contract for deed. So why do you think we call it a contract for deed? Because what happens when an underwriter goes in and somebody says, well, I want to refinance my uniform real estate contract, okay? And I've looked over underwriter shoulders before. They know how to use the Control F button on a keyboard, right? They're looking at the documents and there's 388 pages in the guidelines, and they'll go Control F, which means search for, and they'll type in uniform real estate contract. Guess how many hits come back on that? 0. It's not in the underwriting guidelines. And if the underwriter can't find a term in the underwriting guidelines, you think they just kind of go, oh, I feel good about it, I'll just approve the loan anyway. No, they don't, okay? But you put in contract for deed, and then it all populates, and they go, oh, contract for deed. Now, even that being said, that doesn't mean that they're going to treat it the way that we're suggesting here. But what can happen on this is if the notice of interest is not reported, that your buyer who put down $50,000 on Dave's $450,000 house that he sold for $500,000, that the seller was excited, the buyer was excited, everybody wins, they can't refinance right now. And now they go in there and they see, because the notice of interest wasn't reported, the buyer has to repurchase the loan. He has to repurchase the house. Okay, what that means is there, on a seller finance transaction, we have to source and season the funds for where the down payment money came from? No. Okay, it could have been a friend. Can you have a friend gift you money for a down payment on a mortgage? No. Okay, so that money, that just got kicked out. You can't use the 50 grand. Okay, you can't use the appraised value. You can only go off the purchase price. If the home's worth 600 grand 2 years later, and they're only trying to refinance a 450 contract, they can't use the equity. So the appraisal doesn't matter unless it ends up being lower, then it matters, okay? The interest rate could be higher because the loan to value is higher. You might have to have mortgage insurance on that loan, even though your loan to value is 600, 450, even though we're only at 75% loan to value. Okay, your buyer's not happy paying mortgage insurance on that because the underwriter's saying, well, no, we're only treating this as 10% down because you've got your earnest money, basically, is what it converts to. And then you need some more documentation. Sometimes you only got to get 1 year of tax returns if the loan to value is low. Sometimes you don't need a contract payment history. Sometimes you can push the debt ratios a little bit. I mean, there's flexibility. So you got to make sure that this is done correctly. And in the state's website, in the Division of Real Estate, guess what it does not tell you to do if you use the uniform real estate contract? It does not give instructions to do what? To record the notice of interest. So, okay, so much for that. So anyway, so just be aware that this is something that to protect your buyer, you really need to know how much time does your buyer need. Okay, because there's some situations that might only be 6 months, they might be a year. Okay, but if they need 2 years, how long should you structure the contract for? If you're representing the buyer, how much time do you want to give the buyer on that contract? If you know they need a minimum of 2 years.
3 to 5.
3 to 5, yeah. Okay, and there's ways you can structure the contracts. The way that Dave taught me how to do it on stuff like that, I'm really good at learning from other people. I'm not the most creative guy on my own, but when somebody has a good idea, I just, oh, wait a minute, that's a great idea. Hey, I've got somebody that needs 2 years, but I'm going to do seller finance for them. And you know what? I'll actually make the contract for 5 years. But what I'll do is at the end of the second year, payment goes up a little bit. At the end of the third year, it goes up again, right? Oh, and at the end of the 5 years, okay, well, no, I really don't want the house back, but we could renew the contract because there's some people, it's some people that have got credit issues. It's kind of hard to change their stripes a little bit, but you can incentivize your seller for waiting, right? If the seller says, hey, I want to get paid off in 2 years. Well, what if you're getting an extra $100 a month for the third year and then another 100 a month again on top of that for the fourth and the fifth, and then the buyer will eventually do it. So you can negotiate, right? Because who's the bank in a seller finance situation? Yeah, the seller's like, you mean I get to decide what that terms are? Yeah, the seller gets to decide.
Random question, if it's like a lease option, and because the buyer needs to build their credit up, is there a way where the seller could put their payments like towards their credit score to help them raise it?
It's not going to help.
Then we'll-
Yeah, you can get it reported to TransUnion and to Equifax. contracts, but it's an installment loan. It's treated as an installment loan. The Morris knows the answer to this. Highest and best thing, if somebody wants to have their credit score go up, is it a student loan, is it an installment loan, or would it be a big national bank credit card? Right? Credit card, okay, they gotta go out and start using a credit card, and they don't have to like carry interest on it, they can use it and pay it off every month. They gotta use it, but not abuse it. You know, I always tell people, try to use as least of it as possible, 10% or less, but they need to get a history of it, and if somebody is coached and they understand, and people who put down a large down payment, they'll pay attention when you tell them, this is what you need to do if you want to be able to tap into the equity and refinance this house and get it, because a lot of these seller finance contracts that people are entering into right now, they're above market interest rates. So the rates don't need to go down much at all. They really just need to get to where they can qualify, and then they would refinance, and it would make sense for them to do it. So, yeah.
So, why is the notice of interest have to be recorded, and is that only for contract for me?
It's for a contract for deed, specifically for a contract for deed, yes. But it puts a mark in the sand so that FHA didn't used to care, okay? They used to say, okay, we'll refinance the contract for deed. You used to be able to refinance a lease option agreement with FHA, as long as it was seasoned for 12 months, but there was no reporting thing. So guess what? People who all of a sudden decided that there was equity in the house, you know, sometimes people would backdate documents. Can't backdate a title report. So that puts a mark in the sand of when was the contract entered into. So that's the reason for that.
So this is, if I have a FHA loan, can you qualify for this one?
The seller has an FHA loan?
No, buy,
Oh yeah, the buyer can refinance a contract for deed. Any type of
refinance.
USDA, FHA, VA conventional, you can refinance a contract for deed. It's in the underwriting guidelines.
If the underlying mortgage is the FHA, you cannot do it.
You can do a contract for deed, and Dave will cover this and Jax will cover this, because, correct, because you're not transferring title on a contract for deed. The seller still remains on title. Okay, and so I'm not gonna take Jax's time on that one, but yes, it's okay. You can do a contract for deed on top of any type of government insured loan. And it does not trigger the due on sale clause. So, anyway, so into that.
So if the due on sale clause is triggered, is there a way to get out of it?
Great question for Jax. I mean, it's so easy to just, here, that's a legal question. Just throw that one over. So yeah, save that one for Jax. And I think by the time you get done with it, you get the feeling that there's like some accountants and CPAs and plans. Are there like people with accounting backgrounds? We're getting some questions. We've been doing this since 2009. We haven't had this many accounting questions in a class. I don't think we have we? That's 1099 versus the 1098. No, I know, but I mean, I like it, but that's why, that was the thing I remember I was saying, I was kind of, look, we never get a chance to answer every question, you know, so we just kind of roll through and do it, and we don't want to leave every question unanswered except for the ones that I can defer to Jax or Dave. So, okay, so here's just a couple of seller finance mistakes that can be made on this. And Dave covered this a little bit, so I'm not going to rehash the whole thing. But in 2018, I believe, Fannie Mae and Freddie Mac changed their guidelines, and then FHA and everybody else kind of went along with it. There was a thing in there, there's a term in the underwriting guidelines called excluded debts. Okay, so these are debts that can be excluded from somebody's credit report. Okay, and this is, anybody, you guys can look this up. We're just all transparent about here. We're not making this stuff up as we go along. Okay, we've had to change this course probably at least once a year. We've had something that has come up on the real estate side, the lending side, title side, that really we've had to change the course and update some things, which the state requires us to do anyway. But these excluded debts, okay, so in other words, if you have a parent that is making the kid's car payment, even if the parent isn't on the loan, but you can show 12-month payment history that dad was making his daughter's car payment, you can exclude that debt from the credit report. If it's a student loan, if it's a credit card, if it's a solar panel, I mean, any kind of debt that you can think of, if you can provide a 12-month history that somebody who's not on the loan was making that payment coming out of their account, you can exclude that debt from their debt ratios. Pretty cool, huh? There's one exception. Mortgage. That's the exception. It used to be it was everything including a mortgage. And then they changed it, says, no, we're gonna still keep the guidelines the same, but not a mortgage. So what happens if you have an all-inclusive trust deed or a contract for deed and the buyer's been making the payment for 6 months? Can't count any of the income, zero. Zero income, doesn't matter if his payment's $2,000 a month, sold his house and he's getting $4,000 a month on a contract for deed, your buyer's jacked up because he's got $2,000 a month in cash flow. He sold his house for above appraised value. And a lot of sellers would be in that position. Dave, what are you seeing for some of the cash flow deals?
They're about $1,500, $2,000 worth of cash flow.
I mean, they're nice. I mean, this is a good chunk of money that people are getting out of their cash flow. And they're sitting there going, well, wait a minute. I mean, here's a spreadsheet from Elite Contract Services. Where's Jacob? Okay, all right. I was gonna slip there for a minute. But anyway, but here's a payment history. Look at this. I've got a buyer that's been making my house payment for 6 months or 12 months or whatever it is, okay? Well, what happens is that if it's less than 12 months, you can't count any of it. If you get to where it's 12 months past the 12-month mark, you can count 100% of the income, but you still have to count the mortgage debt in there, okay? Now, I got a little math problem down here, okay? And this is kind of convenient the way I'm doing this. But anyway, you can count, if it's a lease agreement, this is what Dave talked about. And when this guideline changed, I mean, I went back to Jax a few years ago and I said, and all I did is just tell him, I said, Jax, here's the problem. I said, can you draft a contract that would fix this? And then Jax drafted the contract. I mean, I just gave I just told him what the problem is. And then he said, here's how I think we can fix it. So I'm not going to take credit for that, but you know, when the underwriting guidelines change, we need to make sure that we're not putting these people in these contracts where the seller sells his home, gets $50,000, he's got $2,000 a month in cash flow, and then he goes to put another house under contract. The underwriter looks at it and says, well, you don't qualify for 2 mortgage payments, Bob. What do you mean? This guy's agreeing to pay my mortgage payment for the next 5 years, and he gave me $50,000 down, and he's paying me $4,000 a month. Yep, but I cannot exclude the debt. You still have to qualify for your 2, and you can't. Not only can you not count the $4,000 a month in income, but you got to count the $2,000 in debt. Don't be the listing agent that does that to your seller. Okay, I have several of these conversations every week where I'm talking with the agents that have taken the class and said, hey, George, can you run the numbers with my seller? They've got a 3% or a 2.5% or 3.5% mortgage. We want to figure out how much they need to get down, what the cash flow would be. Does it cancel out enough of their house payment on it so that they can qualify for another house? And then what price of house are they going to get into next? The numbers matter on this stuff. They have to structure the contract correctly so that you can, I mean, I call it sneaking it by the goalie, but I mean, it's underwriting guidelines. You got to do it. So we've got a combination transaction that does that. If you don't do it that way, and people, I don't think I'm going to get into the math on it. I got a whole class where I do the math on this.
By the
and
way,
then-
George,
Yeah.
everybody has a reference to YouTube videos
Okay.
that George and I put out.
Okay.
So we go over this entire presentation of more depth. And you can get it on YouTube free of charge for us because it's YouTube.
Yeah.
And it gets into a lot of the details that we're going over. Okay? And I gave everybody.
Okay.
It's either on the back of, it's either on the
It's a
back of
little
your
handout.
spreadsheet or it's a separate app. It's on the back.
Okay, so 2 more things to just cover real quick here, and I'm gonna hand it on back to Dave. Okay, in the last 18 months, how much have house prices gone up? A lot or not as much? Not so much, okay? In the last 18 months, how much has the price of the money to borrow gone up? More than double, more than double. So the houses haven't become expensive because of the house costing a lot of money, right? The money's become expensive. And what this is here, this is just a pricing matrix, and this is just kind of showing a conventional loan. I can't remember the loan amount. I think it was 600,000 something. But here's a principal and interest payment. There's principal interest payment. This at the time for 7.25. If I remember right, this was somebody with like a high 600 credit score. But anyway, so that's what it was costing basically to get 7.25. So it was costing some money to get 7.25. This was a snapshot. I mean, this is like not a good day, but you know what, 6 months from now, this might look good. I don't know. Who knows what direction rates are going. But what is the cost? Let's just call it a $600,000 loan. It was more than that. But what would be, how much would it cost somebody to say, well, I want to permanently buy my rate down to 6.25? How much would that cost? What's the difference between this number and that number? 3%, right? So on a $600,000 loan, how much money would the seller have to pay or the buyer have to pay if they say, I want the bank to give me a 6.25% rate? 18 grand. All right, we got some math majors in here. I love it. Okay, now, but are there some people that sit there and go, well, wait a minute, if I could get the rate at 5.25, that would be better. I mean, how many, if the rate's got to 5.25, do we think there'd be a lot of buyers that would come out of the woodwork?
Yes.
We don't need to get back into the fours. I mean, I think people have gotten used to the idea that, okay, 3% and 2%, that ship sailed, right? And we've been above 6% long enough. And I think if we got this even in 5.5, if the rates got there, I think there'd be a ton of buyers that would come out because, I mean, let's face it. I mean, you got a young couple that saved up, 3.5% down payment. If they make 80 grand a year, how much house are they buying? Maybe 400,000, right? It's sad. Okay, I mean, like 10 years ago, if you had somebody making 80 grand a year, I mean, like, you're like, oh, come on, we're going to the east side, right? I mean, I'm not kidding, right? I mean, that was, and then look, now the rates have gone, everything else, you're sitting there and you got this young couple and they're both making decent money, but they're priced out. If you get back to 5.5, about for every 1% drop in the rate, roughly, okay, you got about a 10% more purchasing power. The rates come down 1%, your $400,000 buyer now is a $450 buyer. Okay, so what is it going to cost if they want to get to 5.25? What's the difference between that number and that number? 8%. 8% is 600,000. Okay, so it's actually, so the loan amount was more than 600, so it's 600 something. Okay, so if you are a seller, okay, so can a bank offer a 5.25% interest rate with no fees right now? If a seller has an underlying mortgage at 2.5 or 3 or 3.5, could a seller offer a 5.5% 30-year fixed rate mortgage? Would a buyer be willing to pay a little bit more money to have their payment lowered?
Yeah.
Are there closing costs on a buyer side for seller finance? Oh, $600. Yeah. Is there mortgage insurance if they put down less than 20%? No. Okay, I mean, I don't want to be the Santa Claus. What was it? Was it the Miracle on 34th Street? Whatever, whether they're sitting down there with the Santa Claus and he's going, oh, Macy's doesn't have that toy, but you can go to Gimbel's and you can buy that. People, what are you doing sending customers across the street? I've had a lot of people, I'm saying, look, if you got 10% down, look for a seller finance. That should be your first attempt to try to do that. If you can't do it, then that's okay. I understand it. But maybe I can help you work with an agent who understands seller finance. There's a lot of buyers out there that have 10% down. You learn how to do this stuff, you can do a lot more transactions, period, end of story, and you are doing a service to the community. That's your job as a real estate agent, right? Help people achieve homeownership. I mean, that's kind of how I feel after I've closed a loan for somebody. It's like, wow. And I get a lot of, it's very satisfying for somebody who didn't think they could buy a house or who couldn't qualify for a loan. And you work with them and you get them and they get into a house. I mean, to see them just embrace their first home, it's like, I want a home. I can have a dog. I can plant trees. I mean, I can paint. I mean, that's kind of cool, right? Isn't that why? I mean, isn't that kind of the why that we're in this business? To see people get something here that people in a lot of other countries can't do? I think it's cool. Anyway, so this is the power of the cost of money, okay? Money right now is expensive, but sellers can offer cheap money and sell their house for more money, $50,000 more, and still have a lower payment at $500,000 with 50 grand down than they would have at $450 with 50 grand down. Your seller finance buyer sometimes can end up being in better shape than the institutional buyer. And this is a comp, I put this up here. So I've got a son of mine, and I'm just going to okay. So this is a transaction, MLS number. Anybody can go ahead and look it up. My oldest son, everything he touches turns gold. Okay, I'm just going to say that. I mean, if he's ever in line to buy a lottery ticket, run up and stuff $100 bill in his pocket because you're going to win. he looked out trying to buy homes for seller finance and went out and wrote offers on about 7 properties that had been on the market or vacant homes that, that he thought would be candidates, right? And everybody, it's like Dracula showing the cross. We don't do seller finance. Go away, go away. And finally, one of the listing agents said, I think I've done this a little bit before. And anyway, so he wrote an offer saying he put down 10% contract for deed, and he paid 4% interest. He didn't know what the underlying mortgage was because that's not part of public records and it's not on the MLS, right? And he was just hoping that somebody would respond. Long story short, after they got done doing the final addendum over about a 3-day period, my son agreed to put down about another $10,000. So he put down about 14%. He put down a little bit more money. And the seller let him just take over the payments on his mortgage, which was at an interest rate of 2 3/4, 30-year fixed. How many times does the counter offer come back to the buyer being a better deal than the first offer? But these deals are out there. There's a lot of them. But back to Dave.
Okay, thanks, George. And that's a really good example, though. I mean, if I'm representing a buyer, I'm gonna try to get the best terms for the buyer, aren't I? And there are sellers who are willing to come in with lower rates than, but if you're a listing agent, you're gonna try to get the most for your seller, right? So we're running a little bit short of time, so I'm gonna skip a few. But by the way, I want to emphasize that if you want to get into a lot more details, George and I each have a 1-hour presentation on YouTube. So we'll go over a lot of the same information and additional information too. Okay, so let's take a look at this. So dynamically structured. I have a listing. People call me and they said, Dave, I see you got seller financing. What are the terms? So let's have a conversation. If I just give you certain terms, then you may turn around and say, oh, my buyer can't do that. Oh, sorry. You ran off with the wife.
No, you
Got
get
too
the
parched. Oh, I'm sorry. I was sitting next to you.
So, but on the other hand, if we have a conversation, we might be able to negotiate something that will work for both the buyer and the seller. So it doesn't have to be a fixed set of terms that will work. Depends on the down payment, depends on how long they need it. It depends on all sorts of things. Maybe I can do an interest-only loan for a few years to keep the payment down. So there's a lot of things we can do in seller financing that frankly, you can't go to a mortgage company and say, let's negotiate this mortgage you're about to give me. No, we don't do that, okay? All right, so one thing that I need to clarify, good question on FHA VA. FHA VA, if the underlying mortgage on the house is FHA VA, you cannot do an all-inclusive trust deed. Title cannot be passed to the buyer. The only type of contract you can do with seller financing, if the underlying is an FHA or VA, is a contract for deed. Because FHA has a rule that if you are a participant in a wraparound where title transfers, then you can be put on their limited participation list. You don't want to be put on that list because that's a list that is checked. The next time you go to a lender and say, I've got an FHA buyer, that has nothing to do with anything. And they check your name and you're on the limited participation list, your buyer cannot get their loan insured by FHA. So you don't want to be on that list, okay? Your broker could be put on that list. The title company could be put on that list. If they're all participants in a transaction where title is transferred on a wraparound type contract, okay? So that's just one thing I want. But you can still do them. They just need to be done on a contract for deed, okay? So how do we write the offer? Oh, somebody turned out the lights. Oh, they're back. We use the reps. George, Jax is going to go over this in a little bit more detail, so I'm going to skip it. Sorry. Whoa. See, wait. Oh, okay, back.
Wait, is that copyright infringement, Dave? Oh, Jax isn't here, so no.
Jackson in here, we don't
It's
care.
not.
Don't say that. He's coming in around the corner. Oh, nice. Sorry.
know.
All right, everybody got the picture they want. All right, so if seller financing is such a great deal, where's the resistance? Well, we already talked about the fact that the homeowner, if you explain them the advantages, they're on board. These guys are the problem. And that's one of the reasons I like to teach these classes. Every once in a while, I'll call somebody and say, hey, I'd like to present an offer to your seller. And they go, wait, you're Dave Kenney. I took a class from you. Of course you can come over and talk to my seller. And then we explain to them what the offer is, and bang, we got a good deal. Okay. But use experts until you become comfortable with them, so that you can add some more tools to your toolbox. Don't not do it just because you don't feel 100% comfortable about seller financing. Okay, more things to chew on. All sales, if it's a seller financing closing, it's still an MLS comp. Great for investors. How many houses can I buy if I'm an investor using qualified mortgages? Fannie Mae, Freddie Mac.
Same as the most.
10. Well, I want to buy 100. Well, then you better start buying houses with seller financing. Okay. Roth IRAs. I have a whole class on just Roth IRAs. Terrific for flips. Don't use hard money. Use seller financing contracts to do your flips. 1031 share. How long does it take to close a seller financing contract? I've done it as little as 2 days. That doesn't necessarily mean you need to do that. It's a good idea to still do home inspections, the same thing we all do. All low closing costs. For the buyer, about $500, $600 is all they're paying in closing costs.
You're sorry for the title company. They don't get a lot of money.
They do.
They do.
Yeah, they still get a title insurance policy. And,
From
yeah.
feel sorry for the lender.
Yeah, we feel sorry.
Oh,
That's what it's like. So they get a HUD, they get an owner's policy, the buyer gets an owner's policy, close with legal documents. These transactions are valid for appraisal comparables. Payments always make to a third-party escrow company. Okay, we already talked about that. Okay, last thing I want to talk about is this very, very busy spreadsheet. And what this is a real example here. Now, the one I handed out is another example, so it's not the one on the board. But, you know, I mean, I know it's busy. Well, I'll quickly go over what this is. So on this side, I have the buyer's transaction. So the contractor here, so this is their amortization. And then in the middle, I have the seller's mortgage information. So I know what we're comparing. And then the seller over here says, well, I've got $70,000 left in equity, and I'm making $1,300 a month after I've sold the house. So, and then this spreadsheet calculates the rate of return the seller is getting on their equity. So in this example, the rate of return the seller's getting is 26% return. And the seller's going, bang, that's good. Would the buyer like to have a 30-year contract? Because I'd be happy to keep that return going. The second one I handed out is this spreadsheet. And so you can take a look at it. I think that's what you have in front of you. Yeah, take a look at that one. And what this is as an example is I'm telling the seller, if you sell your house on seller financing, you can use this cash flow to offset your payment on your new house where the interest rate is higher. And this goes through the calculation. So this particular example is the seller has a cash flow of almost $1,800 a month. They go out and they buy a more expensive home. They buy a $650,000 house, but they apply the cash flow they're getting from the last house to offset the new higher mortgage. And the actual rate on their new mortgage is 1.4%. That's a way you can, and this is what I tell people all the time. How would you like to keep your current mortgage? Sellers say, I don't want to sell because I would lose my current mortgage. No. How would you like to keep your current mortgage and transfer the benefit to your new house? even though you're having to pay a higher interest rate on your new house. And they're going, can I do that? I said, yeah, my name's David. I didn't know your name was David Copperfield. What magic are you doing here? Well, I'm getting a great cash flow on my old house. How do banks make money? They borrow at a lower rate and loan it out at a higher rate. Were banks making millions of dollars when the Federal Reserve had 0% interest? Yeah, banks were making a ton of money. Well, now we, as the private people of this country, have mortgages that are down at 3%, 3.25%. It would almost be criminal to pay those off. We ought to be able to make money on the bank's money. And that's my message to sellers. Don't lose that mortgage. Turn it into cash. And then I go through the example on how they can do that. And all of a sudden they go, wow, why don't more people do this? And the reason they don't is they don't know it's possible. Okay? We already talked about capital gains if it's primary residence. Now, if I'm an investor and I have a rental property, are there advantages to seller financing for an investor? Absolutely. Most investors, I don't want to sell my rental property because I have to worry about capital gains. Well, what if I could get 10% more for the house above appraised value? So now I just got $50,000 more for the house that I can use to pay my capital gains. And I can spread the tax liability over the life of the contract. And all of a sudden my investors said, I'm tired of being a landlord. I want to sell all my rentals. I've done that. I've sold a whole bunch of my rental properties on seller financing. And now the benefit of being a landlord comes to me in the way of cash flow from seller financing without the headaches of being a landlord. Because if the water heater goes out, what am I to that buyer? I'm the bank. I don't go call Chase when my water heater goes out and say, please come replace my water heater. So what are you talking about? We're the bank. So the advantages of being a landlord without having the headaches of being a landlord. So that's my presentation. Any other questions we got here? Yes. George, question.
Is Jax right there?
No, where's Jax?
I don't think he's coming for another 15 minutes, Dave.
Really?
12:30 was lunch, 1 o'clock was the start time.
We started at 1?
Well, we started.
We started at 12:30.
12:45.
Oh,
Well, I don't know, I'll go.
well, I tell you what, we still want to take, you guys need a break. You need a break. Okay, so we're gonna go ahead and take a 15-minute, 10-minute break until Jack starts complaining that we need to come back. And I'll be here for questions. George provided a sandwich, so he gets to make a commercial. Okay?
Oh, Dave, I didn't tell you this. Okay. I've been doing some fishing.
Yeah?
I found a bank. Guess what they'll do?
What?
Gap financing on an assumption.
There you go. That would be great. Assumptions are a big thing.
Right, so you got a buyer that's got, the buyer's got 10% down, but the seller's got an underlying mortgage, like they got an FHA or VA loan. So just say you got somebody selling their house for $500,000, they owe $350,000. Okay. FHA assumable, VA assumable loans, there's a ton of those out there. But to actually assume and they have to qualify with the underlying mortgage lender, but they also have to be able to do a legal assumption, they have to cash out the seller. What's that? Okay. So a lot of people might have the 50 grand to put down, but they don't have the 150. Okay. I've got a bank that will do the gap financing. They'll do a HELOC second mortgage for the 100 grand, they'll go up to 250 on a HELOC. And then knowing that it's an assumption. So anyway, so I just found that last week. Yeah, so there's that opens up a lot more opportunities to do assumptions.
All right, well, very good. Thank you very much for your attendance. Let's take a 15-minute break and we'll come back to Jack. If any of you have questions, I'm happy to answer questions. Yeah, we did it. Yeah, we're good.
That's Janet, she's cool.
Oh, that one? I know that's
We
good.
met her today. She's so nice. I had an argument with my local said, "You used to be a fire."
You want to holler, somebody-
Thanks.
Yeah, holler up the stairs. Tell them.
Okay, that's-
You can't do it, you can.
Yeah. Yeah, that's good. That's a lot, all from you. It's like start buying drugs or buying some weapons. Yeah.
Question, yes.
On your YouTube videos.
If I have a drug.
You know, there's a ton of stuff on YouTube.
Okay, great.
And since we're break time, I do a seller financing education series. It's 11 hours long.
Oh, okay.
Oh,
And it's free. 1 hour at a time. 1 hour at a time. But they're recordings. And so if you sign up for the entire series, you get all the recordings, you can watch them as often as you want. You get the spreadsheet, so you can have that tool to use in your listing presentation. And so there's a lot of good information about seller financing, and we go into detail on how to use these tools to really supercharge your business.
You look so funny with that letters on your face. Just saying.
I look funny without the letters on my face.
You're very handsome.
Until Jack steps in.
Yeah. All right, well, we're gonna get started again. So hopefully the information we've been giving you has been very, very useful. I tell you, I have been using seller financing techniques my whole career. It doesn't just apply to one market or this market or this market. You will always have clients that you can help with these techniques. So they're very good things to have under your belt, no matter what the market is doing, okay? So we're gonna get into the legal side of seller financing. And Jax Pettey is going to be teaching that. Jax is obviously very good as a title guy. He's an attorney. And one of the things I really like about using First Liberty Title on Jax Pettey is I have an attorney doing my closings. And I abuse him all the time. I call him and say, Jax, I've got a legal question. He goes, okay, Dave, go ahead, hit me with it. But he is a very good resource. But First Liberty is one of the only title companies in the state that really has a good handle on how to do seller financing. So I highly recommend you doing First Liberty Title for your closings. Yes.
Just a little FYI, one of the title companies, which will remain unnamed, that used to compete with seller finance, they quit with seller finance.
Well,
They ran a little insurance problem,
yeah.
just thought I'd let you know that the competition is dwindling.
But again, Jax Pettey is one of those resources, though, you can help put together your transactions, okay? So we're gonna give the next hour and a half to Jax, but before we do, I'm gonna have Dave come up. And he's got some things he wants to talk to you about from the Keller Williams side of it.
Yes, it's not Keller Williams, actually, USA Roost.
Oh,
And
sorry.
It's all right, no problem. How you doing, Dave? We just met, by the way.
Didn't we just meet?
We did. Thanks for all this. Let's give a round of applause for Dave so far. At USA Roost, we like to put on events like this and help sponsor them with Jax and George and Dave. For the benefits of agents to do more business, right? That's why we're doing this. So Audrey Slay back here in the corner is probably the one that invited you guys here. So let's all give a round of applause for Audrey. And I heard a quote this morning from Byron Levine over at Broke Agent Media. If you're a team or individual agent that's struggling in this market, do you think it's time that you could strategically align with someone who's done a bigger business than you that can help support you over the next 12 to 18 months while we're going through a shifting market? So in this type of shifting markets, consider cutting costs like a lot of business owners are doing right now. Invest in things that are growth opportunity and make those strategic alignments that are going to help you and your business. So anybody know Josh Stern in here? Raise your hand. Okay, cool. We built one of the largest real estate companies in the state And him and I started USA Roost over a year ago, and we're a virtual lead generation company. And with the coaching platform integrated as well, that's designed to help you take more listings and work with more buyers. And we add 2 agents a month to work with us and have access to our leads. And that way we don't saturate how many leads we have coming in. If you're with a Roost right now, raise your hand. Very cool. So if you see these agents after this, ask them how they like working with us and what benefits they've gotten from it so far. And in the past 2 months, we've generated over 300 leads, buyer and sellers here in this state. So we got some room for growth. So if you have interest, there's a QR code here. Just scan that, fill it out, and then we'll get in contact with you and explain, what's involved. And also at the same time, I'm the director of lead generation for this company, and it's interesting because I was cold calling around one day, calling expireds, and that's how I got hold of George, right?
Yeah.
So that's him and I, how we met like 2 or 3 months ago. He started going into the features and benefits of seller financing with me. And I thought it was crazy because I've never heard of any of this stuff before. And since I've been able to integrate it with my business to help us increase how many listings we're taking and buyers we're working with. So if you ever need help with doing a deal with seller finance, talk to these guys. They'll help walk you through it and even talk to your clients with you. So we really appreciate the work that they're doing with us today and let us know if we can help you out. Cool.
Thank you. Together. So what he said is true. A lot of agents feel like they have to know everything about seller financing before doing a deal. A much better way to do it is find a client they would work for and then do a conference call with one of us. For me, it's actually quite refreshing to go through that with a buyer or a seller because my batting average is pretty good.
What is it? 4?
It's in the 900s.
That's what
Yeah.
you're cutting it.
But almost universally afterwards, they're comfortable doing it. And we're actually gonna go through a slide where I'll go through exactly what I go over with them. And if you understand this slide, you'll be able to talk to anyone at any time about seller financing. But really, they just wanna know, what are the risks? What's the reward for the risks? And how long does the depot remedy take? Like, that's essentially what people really wanna know. Once they know that, they're very comfortable with it. The reason it's in the 900s is because it doesn't work for everyone all the time. But a lot of the major barriers that used to exist to doing seller financing, for example, the seller has to immediately go buy another property, have been eliminated. Now, I'll put an asterisk next to that. If you work with the right people, it's been eliminated. If you walk into somebody that just graduated from teller to loan officer that week, you're probably not gonna have a good experience, I'm just gonna say. But we're gonna go over, and Dave and George do a good job of this, like going over the theory as well. Because the theory is important, right? But the theory is not what makes you money. The theory is what keeps you and your clients from making mistakes. So I'll definitely cover the legal theory side. But knowing how to apply that to actually do a lot more deals, that's where it becomes a lot of fun. And when I talk about this, you'll notice I'm a little passionate, and that's because oftentimes I'll see people like hugging their agents, sometimes in tears, because you took them from hopeless to homeowner, doing seller financing. And that's really cool for me, especially like immigrant populations. I love working with, I speak Spanish, and so with that population, I have a special place in my heart for. Like, they'll generally work really hard and have good income, but if they walk into a bank, they can't get a house. And so we love working with those people, and hopefully you will too. But you can not only make a lot of money, you can help a lot of people. And so I think that's important. So we'll go into that part as well. Now, when I first submitted this to the state, I learned 2 things very quickly. The first one was the state does not have a sense of humor. Because I thought banks, we don't need no stinking banks was a great title, right? They did not. The second thing I learned was, in thinking through it, you actually do want to have a lender that understands this, because for most of you, you're going to be putting your clients in a transitional situation, right? The seller finance may not last 30 years, although I will tell you, right now we're seeing a lot of those last 30 years. If you're a seller and you have, in fact, I'll tell you what I just did. I picked up a property in Magna for $270 without putting any of my own money in. I sold it for $440. And in the contract, I required the buyer to do all the repairs that I would have done. I got my seller's interest rate of 3.5%.
Buyer's interest rate is 8%. Do I ever want them to pay that off? No. Guess what? That buyer is thrilled. Now, I don't think that's bad. My first house was at 7.5% interest. Who's got the highest interest rate they had a house payment on? 8, 14, anyone beat 14? Okay. So, you know,
Hey, I was very grateful.
I know, because at 19 to 14,
Yeah,
that's
I was
good.
very, very, very grateful that it finally dropped to 14.
I love that. Now, here's the other thing I just say. If you take notes the right way, this will be very valuable for you. It'll be good time spent for both of us. If all you do is listen to me, or even worse, like you're doing I'm paying attention to my phone and listening, look, I promise you, this has made millionaires that have come to this class and have done what we teach. Right? One guy within 4 years made $2.2 million net. And it's not rocket science, it's just a matter of doing it. So I understand the lecture might give you the 7%, but really, let's look down here, right? How would you teach this to a listing you had that expired? How would you teach this to a buyer that's sitting on the sidelines right now? Why are buyers sitting on the sidelines?
Not qualifying.
What's that?
Unqualified.
Not qualifying, right? You know what the qualification is in seller financing? The down payment, generally. Another reason is the higher interest rates, right? If you look hard enough, you have sellers that are willing to give you better than market interest rates. We see that all the time, right? So it's just, how are you going to advertise it and find those clients? So really try to think of it as, how would I teach somebody? If you have an expired listing, or you have agents in your office that are frustrated with listings aren't moving, especially high-end properties. These are almost the easiest seller financing deals to do, because usually they're business people, they understand contracts, and the house is not an emotional item, it's another asset. So it's very easy for them to do seller financing. I'm gonna have you write some things down. Some of these are going to be general legal principles that might save your assets. I did say F's on the end. But first one is, don't give legal advice. And over again, I'll ask, who's been told that? And everyone raises their hand. And then I ask, who would feel comfortable standing in front of a robed individual, the judge, and explain that what they did was sharing their expertise versus giving legal advice, and where's that line? Like, nobody's jumped up and said, I would love to do that, right? So that terrifies me as an attorney, because all of you have been told don't give legal advice, and your brokers failed to tell you how to not give legal advice. So I'm going to give you, and I think the best explanations of complex theories are the simplest ones. I'm going to give you how to not do that, right? If you're a broker, write this down and teach your agents. If you tell somebody what to do, you have given them legal advice. If you tell someone what to do, you have given them legal advice. If you send an email that says, you should list your house for this price, you've just given legal advice. Can you be held responsible for that? Absolutely. If they find out that someone would have paid 50 or 100 grand more, they could sue you and win. So the semantics are important, right? You want to say, based on the comparables, this is what it appears your house might be worth. What would you like to list it for, right? It may sound different, and maybe that's not important, but it is. The other thing I would say is, and this is one I love, like my staff knows this very well. You'll never hear another attorney phrase it this way, but you are in a litigious society and you're dealing with people's generally biggest asset. And that's why we see a lot of litigation when it comes to real estate agents. And the problem for you is, if it's you versus somebody from the public and it's a he said, she said, who wins? The public. Is that fair? Absolutely not. Is that reality? Yes, it is. So this is the key. If it benefits you, get it or send it in writing. I call it a golden email, right? You told your clients to do something, they said they were going to do something else. The email might sound something like this: Dear Mr. and Mrs. Stupid, I mean, client, most people would do this in your situation and you decided not to. You put a period at the end, not a question mark. Because I've been in front of the board representing agents. I've been in lawsuits where the golden email was what saved that agent. I actually had an agent that called me and they said, I didn't follow your advice. And I went through everything with the board and they said in the end, you know, I guess you really didn't do anything wrong, but here's your choice. You can pay $2,000 and appear in the magazine, or you can pay an attorney, I don't know, 40, 50 grand and probably what you want to do. Like they literally said that to you. So I would suggest golden emails are a good thing for you. So that kind of springs off the don't give legal advice. The second thing, and you don't have to write this down, right? This is Dodd-Frank. This is some legislation that I had to put in so that we can get court credit for you. Like the more boring and methodical it is, the more easy, the more likely it's going to get poor. But as of 2013, Dodd-Frank thought it would be a good idea to require 30-year mortgages for all seller financing, which is, it's pretty apparent these people are not market people, they're special people. So what attorneys do, good attorneys, is they will find the rule so you know what it is, and they'll find the exceptions to the rule so you can actually do business. First of all, I want to say the CFPB has made it so if it's just one property a year, no problem. Less than 3 properties, they just can't be the builder on. CFPB, by the way, there's no penalty other than they want a loan officer to originate the loans if you're just using seller finance as a way of circumventing being a bank. Does that make sense? So if you're a big builder and you're building hundreds of homes and you're financing those to people, CFPB wants you to make sure those are qualified loans. But for your clients, that's not going to be an issue. But if you did, for example, have a client like some of mine where they will go and they'll buy properties on seller financing and then they sell them and they're doing 3 or 4 of these a month, there may be some additional qualifications that we want to go over. Okay, so again, simple takeaway. If your client is selling their house for less than 3 a year and they're not a builder, you're probably not going to need to worry about any of this. But one of my clients that does a lot of them, I taught him that these 3 items are exceptions. So if it's land, commercial, or sold to an entity. So what he does is he has all of his buyers form an LLC, $55, and you don't have to worry about it. But don't get too caught up in this. There is really no CFPB police. I've scoured like everything nationwide. I've never seen this even brought up, but I did want to give you course with it. This I think is important. CFPB does not need, or the seller financing does not need to be TRID compliant. So you don't need to do disclosures. You can just do the REPC, you can seller financing addendum, and you can close. What is the average closing time for a seller financing deal? Yeah, a couple weeks, as fast as your clients want to go. Don't skip over your responsibility in due diligence. If your buyer wants to skip their due diligence, send them a golden email, right? Most buyers would get inspections and different things. You decided not to, period. And I'm trying to go through this quickly because I want to get to the more important things. The farther I go into this, the more important information. This would be the first thing I'd say that is really important. That is, we're going to go over your seller financing addendum that's on the MLS. Anyone ever use this? Okay. There are some major issues with this, and it frustrates me because the people that write these forms for you are not litigation attorneys, and they don't run them by litigation attorneys, and that is a problem. In fact, there's one huge liability issue for you guys as agents in this. Now, just so you know that I'm not trying to hide the ball, the insurance or the real estate commission found out that I was not a fan of their form. They invited me up to explain why I wasn't a fan. So I gave them like my 5-year-old at the time could have understood bullet points, 10 items. And each item I went over, they would turn to each other and they would say, oh, you should really fix that. That's good. They fixed one of the 10 items. They put an addendum number on it finally. So, you know, give them a little applause. That's good. Here are the things that are issues. Now, because I would teach agents this, I started getting a lot of agents saying, can you write an addendum that fixes it? And that was taking so much time, I just wrote my own seller financing addendum. Would you guys like me to send that to you?
Yes.
Okay, we'll go over that one as well. I'll send it out, and there's no fee to use it, you can use it as much as you want. But first thing we're gonna talk about is in this section.
And would you addendum in that's
Absolutely, it's drafted by an attorney. So use the rep sheet and then the seller financing addendum will send. So in the rep sheet and in real estate in general, buyer and seller each pay for their own escrow fees, correct? Okay. Why then did whoever designed this form decide that whoever selects the entity that's going to generate the documents gets to pay for all of those costs? Does that make sense to anyone? No, so if you're using this form, right, number one up in this section, just right. See, right here it says, shall pay for. Just put, you need to do it at the end of this addendum, something that says, both parties shall be responsible for any costs of generating documents. The documents are generally cheap, right? It's funny, because if I generate them as an attorney, it's like $3,500. If I generate them as the title company, it's like $135. Same documents. The next thing we're going to talk about is things that are missing in the credit terms. Now, for bonus points, what 3 things do you need if you're going to calculate somebody's loan payment? Yes.
APR. Or, I mean, the APR rate that.
Well, if you're going to calculate what the payment is, yeah, what are the things you need?
principal.
Perfect. What's missing from your form? One of those 3. Term. Where's the term? Like you have to have that to know how to calculate the payment, right? So it is. So if you're using this form, you're gonna have to do it as part of an addendum, what the term is. Is it a 15-year term? Is it a 30-year term? I've had where people using this form have called me and said, and I get these calls all the time, Jax, you said if it was something weird or stopping the transaction, give you a call. I said, okay, what is it? They said, we've got a problem. The seller wants a certain interest rate, but the buyer needs a certain payment. And I instantly knew the answer. What was the answer? Term, right? They used the term. They stretched it out to a 60-year amortization. Seller got the interest rate they wanted, buyer got the payment they needed, the deal closed. Right? So make sure you understand, term is not in here, and that's an important fact. We're gonna go over some things like late payment penalties when we get to the other form. But there's one big thing on this one that I think is problematic. And I'm gonna give you a fact pattern to help you understand why it's problematic. And I want the first person to figure out what the problem is to just raise their hand, okay? By the way, the problem is not that I'm the buyer, for those of you kidding, but I am the buyer. I'm just a happy-go-lucky attorney that's never actually lost in court. What could go wrong for you? And according to this addendum, if it's filled out a certain way, I'm going to send all of my personal information, credit report, work history, and everything. You look like a great agent. What's your name? Marky. Marky's going to be my agent. I'm going to send that to Marky. And maybe I fax it to Marky, and it sits on the whose fax is this for a while, right? And then Marky's going to send it to the listing agent. With a beard like that, you've got to be a great agent. What's your name?
Absolutely. Oh, Austin.
Austin.
Yeah.
So she sends it to Austin's office. Austin's having the best golf week of his life. So he gets back the next Monday, takes it off the fax machine, and sends this information to a seller that I've never met before. I don't know. Anyone see a problem with that? Yes. What is it? If somebody steals my identity, who gets sued? The broker, the agents, the seller, anyone that touched that information. Now, why do attorneys sue everyone? Is it because we're mean and nasty? There are some really mean and nasty attorneys. I'll grant you that. I'm not one of them. I'm one of the 6 happy ones. But the reason attorneys sue everyone is because we have to represent our clients to the best of our ability, the best way possible. And I know I'm going to get a settlement from everyone on that list because they can't prove it wasn't them. So don't touch that information, right? That's the big one I want you to remember on this one. If you have a client that wants that information as a seller, don't let it go through your hands, your transaction coordinator's hands. Have them sign a hold harmless. I'm happy to help you draft that, because really, you want to make sure you're not part of that chain. And you want to make sure the buyer and seller sign something saying that you're not going to be included in a lawsuit in the event somebody does steal that buyer's identity. Now, one more thing on this form, and most of this we're going to go over in the next form. But number 8, title insurance, right? This is another potential liability thing. One of my passions, and I feel like my job, is to watch out for your liability and licensing. And so this is a liability issue. Because if you start doing this, you might have a seller say, hey, the buyer marked shall not. Now, if you read this, this is not, is there going to be an owner's policy? The REPC is going to grant an owner's policy paid for by the seller, owner's policy of title insurance. This is the buyer going to purchase a lender's policy for the lender? Who's the lender? The seller, right? So a lot of sellers right now have a lot of equity. Let's say your seller has a few $100,000 in equity, and they ask you the following question. The buyer marks shall not. Should I have them buy a lender's policy? Now, the first thing I would say is, what is every bank going to answer that question? Yes, right? If you say, don't worry, nothing could ever happen, who just insured their lender's policy? You did, right? So that's the liability thing. Another one I don't necessarily like, but maybe they should point out a little better. But generally, if there's a lot of seller's equity, you don't want that exposed, because they had an owner's policy, but guess what? They're not the owner anymore. So that's not in play. Now they're a lender, so without a lender's policy, if there's a complete failure of title, the buyer will get back the money they put in, but there's nothing to cover the seller. So be aware, that one's one, if you're on the listing side, you want to be aware. All right.
Jack,
Yes,
should be in the future, mandatory. The lending
only if
policy,
you're very intelligent.
it's mandatory. Just like last week, only we borrowed money from the bank.
They,
They forced us to buy.
I agree.
So why the seller cannot force that?
The seller
Automatically.
can't. The seller
Automatically,
should.
just like the bank. Automatically.
When I consult with sellers, we always put it on. Somebody else had a question. They were just waiting. Okay. Waiting's good. All right, so the other one, on the first addendum, you'll notice they had exactly 2 options. They had note and deed of trust and all-inclusive note and deed of trust. Anyone know the difference between those 2?
The other one doesn't have
Yes.
Underlying mortgage.
No. So if there's an underlying mortgage, you're going to use the note and all-inclusive deed of trust. It is not fatal to the contract if you select the wrong one. If you need to know which one to select, call me. I'll look up on the title records. Or actually, I'll have somebody do that for me. And we'll tell you if it's going to be an all-inclusive or just a note and deed of trust. Easy memory trick, you can write it down. All-inclusive includes all other loans. That's how you remember. Now, this one has the option for a contract for deed, which Dave and George are giving you some exposure to. The contract for deed, like, I'm so glad it exists because it is such a useful item. Sometimes people will ask me, what's my favorite document? I don't have a favorite. Unless you tell me, am I the buyer or am I the seller, right? Because there's benefits to the buyer and benefits to the seller, but one might be stronger in one contract versus another. So when we get to that slide I'm telling you about, you'll see why there's that benefit for the buyer or the seller. But this one does have amortized over. So this one is going to give you the option of what you need to put in. What is it at? How long is it amortized for? Now, what's the longest amortization you can do? Yeah, you could do interest only, which is an infinite amortization, right? So you can use that as a buyer's agent as a way of giving the seller a really favorable interest rate and still getting your buyer a pretty good payment, right? So it's a good tool to use.
Is
Yes.
this the form that you wrote to take the
Yes.
place of the other one?
Yes, it is.
So when you write up addendum, you might use one of the other. You cannot use both.
Yeah, one or the other.
One of the other.
Yes. Yeah. All right, so another thing that's important to put in is, that's not in the other form, when are the payments going to be due? Have you ever had a client that got paid in a strange way and they really preferred to make payments on the 20th of the month instead of the 1st, right? I bought a lot of commercial real estate. All of those payments are due on the 22nd with a 15-day grace period. Almost all of the commercial I bought has been on seller financing. So that's a useful tool as well, right? Talk to your clients. When would be the best time for you? Maybe all their credit cards bills hit at the first paycheck, so they want to pay it on the second paycheck. So it's something you can use. So the next one is first payment date. Now the first payment date can make a difference on how much the buyer and seller bring to closing, because if we prorate the payment like a bank does, so if you're closing on the 15th of the month, let's say this month, August, and you have the first payment in October, is the buyer going to bring 15 days or 16 days worth of interest in the closing like they would with the bank? So the first payment date can be important. Now, I know this feels kind of like drinking out of a fire hose. So I don't want you to get frustrated. I don't want you to be like, I can't remember everything. That's not the point. The point is for you guys to have exposure so that you know there are options. And so when you look at the form, you can call me and say, I had a question about this. You mentioned something about the interest making a difference, and we can go through it, right? So don't feel like you have to remember everything, but take all the notes you can, because you will remember more. So when we talk about the late payment penalty, this is going to depend on, are you representing the buyer or the seller? The average that I see is 5 days, 10% penalty if not paid, and 10% default interest. I'm going to tell you, and I want you to write it down, if there's an underlying loan, use 5 days. Because a really bad idea is to put 15 days. Why?
You late on your, I mean, the seller late on their payment.
Yes. Does everyone understand why? Because if the payments for the buyer late on the 15th, when might they make the payment? The 14th. And it takes the escrow company a few days to get that payment deposited and sent out. So your buyer's on time and your seller's getting hit with late payment penalties, that's an angry seller, which you never want, right? So that's what I'm saying. If there's an underlying loan, go 5 days.
The amounts though, you said 5 days or 10% of the.
10% penalty and 10% default interest. That's typical. Now, when I buy a property, I put 15% or 15-day grace period, 5% penalty. And I explain that's what banks do. It's got to be the best, right? That's because I'm the buyer. When I sell, I'm always at 20 and 20 because I like strong penalties. It depends on which side you're on, right? But don't be surprised if, because now you have knowledge and knowledge is power, that you can benefit your clients. Case in point, I had an agent that came to this class named Raquel. She spoke Spanish, which is a huge benefit. She went and talked to all the little markets and people that talk to everyone and said, hey, if you have somebody that's got a down payment, I can get them into a house. They don't have to go to a bank. And she did her first one and she went back and talked to everyone and said, hey, I did it. And now, like she closed another one today. It's like this river of work that she gets at buyers. So how do I know that some agents don't actually pay attention to the contract? Because every time she would put the default interest rate as 3%. So you'd have like 7% normal interest, but if they're in default, the interest rate goes down. Does that make sense to anyone? We closed multiple transactions, but the agents, I don't know if they weren't paying attention. I have no idea. One agent finally caught Raquel. You know who it was? She made an offer on one of Dave's properties. He's like, no, that doesn't work. But you could probably do some favorable things for your clients if you understand how that works, right? So now if you're on the listing side, you're going to know maybe a little stronger. If you're on the buyer side, maybe you put 5. But again, typically what we see is that 5, 10, and 10. And then escrows, this is a good one to fill in, right? We want to know what's the total payment going to be. So we need to know what are the taxes and insurance. You generally get that from the seller's mortgage statement. because you want it to match what their escrow account is. Any questions on that? Okay. Yes.
So if you're paying mortgage insurance.
That is a fabulous question. So her question was, if they're paying mortgage insurance, that is not on the state form as something that the buyer would pay for. So you want to make sure as a listing agent that any mortgage insurance is also passed on to the buyer. Great question. Somebody else had a question. Yes.
On the HOA fee. Understand that it's okay if the buyer is going to pay for the HOA.
Correct.
But who will be responsible for the HOA?
So,
Understand what I mean?
yes.
Yeah, who is going to transact or negotiate with the
So-
HOA? It's me, the buyer,
The
owner?
owner of the property, which is going to be the buyer, should be the one that's on the records of the HOA. However, multiple times, and you can't do this with an all-inclusive, but with a contract for deed, we've had the seller and buyer postpone paying those fees until the buyer pays off the contract. So if you do, what he's asking is who's gonna, some of these HOAs have outrageous transfer fees. You guys notice? So if you're doing a normal transaction, those are gonna be paid every time. But with seller financing, if you do a contract for deed closing, you can wait to pay those until the end, when the buyer pays the contract off. But generally, the buyer is going to be the one that's going to be on the records of the HOA.
I really appreciate your answer, but my English was not good for to explain. Who is going to be responsible to make decision with the HOA and they come to raise the price or they need to do some service in the building or something like that? Who is going to be the person that will question or receive
Generally
information
the
from
buyer.
HOA?
Generally the buyer, but it's going to be the individual that's on the HOA's records. So if you did the HOA transfer at the time of the seller finance closing, it would be the buyer.
So it's okay for the company that the HOA company that take care of the property. So we can send them the contract and they will record the name of the buyer.
Oh, yeah.
So their negotiation.
They will
or
always
contract-
take their money.
Okay.
Yeah.
So,
Good question. Okay. So we've gone through late payment penalties, we've gone through the escrows. Any other questions on this one? Now we'll go on to the next page. So balloon payments.
So, Sure. The PMI of the escrow.
If you're on the listing side, I would definitely do that. Okay.
It's on the blank.
On the blank part,
Yeah.
if the buyer's paying for it, you should have it. Yes. So when I got into this 25 years ago and started kind of doing seller financing, I would see a lot of balloon payments. I don't see many balloon payments right now for the reason I explained, which is why would you ever want the buyer to pay off if you get it the right way as a seller? I am seeing prepayment penalties. Now, here's something that might blow your mind. We were doing a whole lot of seller finance work when rates were super low. And what's funny to me is I'd run into people that are like, oh, you're probably not doing a lot of seller financing right now. And I'm like, no, we're killing it. Imagine if you've known this, right? Think of every past client you had that you'd sold a house to, that now they had equity, which is debt equity. Debt equity is money it's just equity that's not making any money. So imagine if your clients could have all done this. They take out a home equity line for free. And you have an investor come in and buy a property. So now this buyer, seller finance buyer, gets to pick any house they want. Oftentimes this would be new construction. And there'd be a contract to sell it the next day on seller financing on a contract for deed, where your client gets all of their money back and they're making about $1,100 a month. And worst case scenario, buyer and seller finance buyer stops making the payment. Your client gets a property back that's now got well over 20% interest for you to resell. Does that sound pretty good? I'll repeat that. In fact, a lot of people are visual learners. So here you have the house, right? My art is not for sale. in case. So this is your client. So this is the one that bought a house, took out the home equity loan. They're going to go buy a house. By the way, you don't lie to the lenders on these. The lenders we work with on these, they know what's going on. In fact, they would actually use the end buyer and their seller finance payment to help this seller qualify for that loan, which is pretty cool. So we'll do this as your client. This is the end buyer.
And our client is looking to buy or sell.
Your client is looking to be an investor.
Okay.
So they're gonna buy the house. And the next day, this buyer comes in with more than 20% down, because your client got the 20% from the home equity loan. So their funds are used for about 24 hours. And now this buyer got the beginning house they wanted, which they're super happy about, and they brought in over 20%. Now, investors that I talk to, they think a 10 cap rate is phenomenal. I think it's garbage. Like, I love infinite cap rates. Infinite cap rates mean you have no money in the deal and you're making money. So that's what this person would do. They put money in, they get the money back, their home equity line is paid off, they've maybe made 10 or 20 grand up front. Now, they would raise the price 10%. That's just part of the deal, right? So they raise the house 10%. That's to partially pay for your commissions, to partially to give them some additional payment. And then the buyer is going to be paying usually a 7% interest rate, and theirs was at high threes, right? So they're making pretty good cash flow. Could you have done more deals if you understood how to do that 2 years ago? Absolutely. And you know what's funny? Once these people started doing it, they wanted to do it over and over and over again. And I tried to teach this to agents. If you guys have a client that's got 100 grand and they're like, I want to be a real estate investor, and you go help them buy a house that's a rental property, you've shot yourselves in the foot. Because once they put that 100 grand in, they don't have another 100 grand to go buy another house. But with seller financing, if they put the 100 grand in, they buy it, then sell it on, let's say, a contract for deed. They get all of their money back from that buyer. Right, that one in Magna, my buyer put down $128,000. I got all of my money back plus some. So if you can help your clients to do that, now they've got 100 grand to go to the second property, and the third property, and the fourth property, and the fifth property. And that's great for you as agents, right? And that's great for them, yes.
Question, so the end buyer, is the advantage for them that they can now get a house that they probably wouldn't have been able to get previously? Is that why they
Yes.
want?
Because back then, how many homes were listed as seller finance properties? Like very few, right? But these seller finance buyers, they've got money, right? It's amazing to me how many buyers have big down payments, but they don't want to buy a crappy house. So, and the people that did it like 5 years ago, they're sitting pretty, aren't they? They got a lot more than 10% equity. So it works for both, and it has to work for both. But I use this in a really cool way. I got another one of those phone calls. Jax, I don't think you can do anything with this, but here's the situation. It was a divorce situation, and the wife had received $250,000. Is that enough to go pay cash for a house and sell it? No. So she couldn't get a house. She also had no income, no job, no career, hadn't worked for a long time because she'd been taking care of the kids, right? So she's got the kids now, 4 of them. Is that a great spot for her? No, it's not. And not for the kids. So he's like, you probably can't do anything. I said, sure. So we had her do this 6 times. She was making an average, and still is, of $1,100 off of each home. Now she's got income, right? And she went and bought her own house, and she gets to stay home with her kids. That to me is when it gets really cool. You can like take people from, again, hopeless to a really good spot. I thought that was awesome, yes.
What are the taxes?
The tax implications are you're going to pay taxes on what you receive as you receive it, right? So most investments, you put 100 in, you get 100 back. That was your basis. Now she's paying income tax on the $1,100 a month per property. because that's income. And it's funny, I'll be at the closing table, someone will be like, I'm gonna pay a lot in taxes. And I always say, I'll pay your taxes, just give me the money. Nobody's taking me up. All right, let's move on. And by the way, I love the discussion because none of these classes are the same for me based on the question. We'll go the direction you want. But I also want to get through the material. So any other questions before we get back to this? Yes.
On average, how much are you seeing homes go for above market price?
That is a great question. So it's usually the sellers will use a good interest rate to get a really high sales price, or they'll use kind of a good sales price to get a really high interest rate. You can get both sometimes, but typically it's going to be in that 10%, somewhere in there. But I don't want you guys to think that these buyers are like the dregs of society. They're not. These are people, I mean, a lot of the people I deal with are so high end, it's worth more to them not to take the time to deal with the bank than it is to pay more for the house. Like the stuff in Park City, I can tell you stories. Well, I had a guy do a $3.5 million house. He put down $350,000, and we did a contract for deed purchase. And I made his attorney write me a letter saying, don't record the notice of contract, because he's completely exposed. Then I didn't know at the time he was in a divorce, and that's why he didn't want it done. But once the divorce was done, he wrote a check and paid it off. He called me 2 years later and said, do you think I should transfer title in my name now? I'm like, oh my gosh, definitely more money than brains. I mean, he had $3.5 million just sitting out there exposed. But there's a lot of money out there and a lot of people that want to buy, especially investors, right? Especially if you work with investors who are like, sorry, I hit my 10 limit. I can't get any more investment loans. What's the limit on buying seller finance properties as an investor? Great. Having said that, if it's done incorrectly, it can be problematic. If you don't know what you're doing, you could lose money, right? But if you have people that can help you, you should be pretty safe. Okay, so we've gone over balloon payments, we've gone over payment penalties. Due on sale. This one, if you're working with an investor or you're buying it yourself, is a very critical phrase. Do you want there to be a due on sale clause on the financing to the buyer or not? Now, I happen to be of the belief, like the California Supreme Court, that seller financing does not damage the original seller and it doesn't damage the bank. Because now I've got multiple people responsible to make that payment instead of just one, right? And so when I buy, I always select there shall be no due on sale clause because I know I'm going to resell it. I would suggest for your buyers, that's probably a good clause to select. Because if the first buyer has significant equity now, they're not going to want to let that go. They're going to make a payment and foreclose out their end buyer. But if your seller wants there to be due on sale clause, they'd select the first one. But most people don't even know you can make that selection. So this form gives you that option. Now, escrow companies. Let's talk about escrow companies. There is one escrow company that I think was put on this earth to teach me patience. And they're in Ottawa. I can't mention who they are. But oh bless them. Yes. I think it's helped. Like I've learned how to hide my anger and impatience better because of this. There's one here in Sandy. They're Elite Contract Services. They're really easy to work with. There's another one called TLC. TLC is the most expensive, but they also do the most. They'll actually log into the seller's bank account or mortgage and see if the escrows have changed and adjust the payment automatically. But they're $300 to set up and $30 a month. Most of the others are just $100 to set up. So there's a few choices, and based on your client and the deal, I can tell you which one I'd probably recommend. It may not be the first company I mentioned. Just throwing that out. That's the first company I didn't mention. I'm going to slander any company, no matter how horrible. I mean, no matter how they may do business. All right, so how do we solve for the issue of liability when it comes to personal information? This is how you solve it. You have, if the seller wants to pre-qualify the buyer, have them go to a lender that understands seller financing. And have that lender write a letter to the seller. That's the easiest way to do it. It solves for SAFE Act issues. It solves for the issue of giving that information to a seller that may or may not be credible, may or may not steal that person's identity. State Farm has figured it out. Like, you go to Bear River, their heads catch on fire. It's pretty interesting. But yeah, hazard insurance is something you should be aware of when it comes to seller finance. Now, property tax proration is another one that I think is really horrible for you agents that it's not on your form, because here's what happens. You're a listing agent. You use the form, you did everything perfect according to the form. We're closing in October. This is a high-end property where property taxes are 10 grand a month. And your seller looks down and takes a tax proration to the buyer for $9,000. Why might that seller be a little ticked off? Yeah. Did they or did they not already pay their money in the escrow account for taxes? Then why are they crediting it to the buyer if they're not going to get that back at this time? Right? So property taxes can be a big deal for your sellers when it comes to seller financing. So do you want to prorate it at closing, or do you want to prorate it once the seller financing is completed? Closing. Probably, well, if you're the seller, you probably want to do it once the seller financing is completed, because that's when you get your money back from the escrow account. If you're the buyer, yeah, you might want to prorate it at closing because you have to bring in less money and the seller's out those funds. So again, I don't bring this up because there's necessarily a by statute right or wrong way to do it. But these are things that you as agents, I just don't want people coming back on you at closing saying, I'm out 9 grand, your commission's 14. Let's talk about how much you're going to contribute to what I just lost, right? Anyone ever had that happen? Isn't that amazing? Like, if everything goes right, or they're like, hey, here's an extra $5,000. No, something goes wrong, they're like, ugh, I don't want to pay for this. Look at all the money agents make. That's ridiculous to me. Yes.
So the question I have on that one is so let's say it's the middle of the year, 6 months. Okay, we're doing seller financing, so we're not gonna actually close this, meaning we're not gonna transfer the property until 2 years.
Yeah.
That's why I'm thinking, well, I don't wanna wait and get all that money. Are you saying, so I'm paying it now, and then you're in 2 years from now, you're gonna give me 2 years worth of that back, versus if we do it today, I paid this much today, I'm gonna get mine back, and you're gonna pay that much moving forward. That's my confusion with that
So,
question.
great question. So here's how it works, right? Option A is, I'm the seller and I'm gonna credit the buyer half a year's worth of taxes at closing. Even though I'm not getting that money back, because my loan's not being paid off, right? And the other reason I kind of don't like it as a seller, most of these on seller financing, lease options fall apart all the time, but on seller financing, most of them complete, some of them don't. So if I'm a seller, I may not want to give that money out, hoping I'll get paid back. Okay, so again, is there a right or wrong way? Not necessarily, but at least now you know there are options. The best one of all of them, the one that I like, is actually down here. It basically does the same thing that would happen with a normal loan. In a normal loan, I, the buyer, am going to pay into an escrow account, right? At closing. And then when I pay off the loan, I'm going to get whatever's left back. This does the same thing. The buyer pays the seller the amount that's currently in escrow, and the seller prorates the taxes. That way the seller gets their money back that they put into escrow. And then when the buyer pays the contract off, it reduces whatever the current escrow balance is from the payout. So it works pretty much like a normal loan would. But you have, again, 3 options. Now, if your head is spinning and taxes are just making it worse, you're okay. You don't have to understand it. In fact, Raquel still tells me, she goes, Jax, I have no idea what I'm doing. I'm like, you're doing a good job. Okay, so we got to hazard insurance.
So if the
property tax
seller
provisions.
doesn't have an underlying mortgage, would you still recommend
If
completing?
the seller doesn't have an underlying mortgage,
Then-
I would send the seller's prorated taxes to the escrow company.
Yeah. Okay.
Everyone understand that? It's okay if you don't, like, you're not, yeah, I'd rather have you like say, no, I don't get that, and have me explain it versus, you know, doing this and being like, okay, was that a please explain that? Okay, I will. So if there's no loan, it's paid off. What would normally happen is the seller would just pay the money to the buyer, right? Credited at closing. But then when November rolls around, the buyer's gonna have to come up with those funds. And I know this is shocking. Not all buyers plan for things they have to do. So it's a better idea, instead of the seller crediting that to the buyer at closing, to put it credited to the escrow company, so they've already got the seller portion. And monthly they collect the buyers and pay the tax. Very cool. Okay, so like, I know some of you are finding this as interesting, like some of you are like not as excited, but that's okay. All right, request for notice of default. This is funny to me because California and most states on their state form have this as an option. Utah does not. What is it? It might be important for the buyer or seller to know if a foreclosure has been started on the property. Would you agree?
Yes.
So if you put a notice of request for notice of default in place, that attorney has to give you notice. And so you'd be amazed, right? Sometimes it's something as innocuous as the previous, like the taxes had changed, but the escrow company wasn't informed. Now the payment's short, foreclosure starts, and nobody figures it out till the notice of sale is on the door. That's a bad thing. So to protect your clients, I would probably have a request for notice of default filed. Yes.
Would that request for notice of default, let's just say your title company does it, would that also bring up any encumbrances that were on the property that the buyer might not know about?
So the title report,
Oh,
right?
okay.
So they get a
So
policy.
you're still gonna get that, you're right. They get the
Yes,
power,
but
okay.
there's some cool things you can do with seller financing. This is something I don't normally teach. Like I bought properties with huge liens on the property that no one else would buy. Do you want to know why? Because I know how long those liens take until they fall off the property. I bought one down in American Fort. The guy had like 150 grand in liens on the property. I counted that as my down payment. Let me repeat that. I counted that as my down payment. Interesting. So I was not very much money into that property. It's right near the temple down there, and it's worth probably close to $1 million. The underlying loan's down to 350. Right? So if you have a seller that's like, oh my gosh, I've got this judgment, but the company the judgment's in favor has gone out of business, I can't sell my house. They can sell it on seller finance. You just put a prepayment that's equal to that judgment in the seller finance so they don't pay it off early. Like you can do some really cool things with this if you understand how to do it and how long the timelines are with judgments. Most judgments are going to be 8 years. Tax liens are 10 years just because they said they were. That's how it is. But if you have a seller that's got judgments, you can still sell their house without paying those off if you know how to do it right.
Interesting.
What's that? They do. The only thing that doesn't ever fall off, I shouldn't be smiling this much. It's an attorney's. Those last forever. Sorry.
But can they renew those judgments though after?
They can, but if you've already changed title, it just renews against the person, doesn't reattach to the property.
Okay. Okay.
Yeah, and good attorneys know how to make, help their clients. Okay, so we've
Well,
gone
I'm
through both
sure
of
know how to make
these.
money.
Let's say this, like your client is like, you know what? This is the house dad built. I just want to make sure whoever buys it takes care of it. Well, you can ask for a right of inspection. Seller can do that on seller financing. Did you know that? Sometimes that's the thing that makes the seller feel warm and fuzzy and do the deal. Another thing you'll probably want to do on the buyer side is get a copy, obviously, of the mortgage statement and the underlying note, just to make sure there's nothing weird going on there from the seller. Another thing you can do, and I would recommend this if you're on the listing side, is require that if any structural alterations are made to the property, that those be approved by the seller. And that can save a lot of headaches. Yes.
So the copies of underlying senior, right? How often do you? Is it just in the beginning that you ask?
Yes, just in the beginning, or the due diligence.
But can you ask for it later, just in case it's relevant or something?
So the problem with asking for it later is, if you didn't select it here, how are you gonna force the seller to do it later when they've already got their money and there's no motivation for them to do
No,
it?
I mean, ask it in the beginning and then kind of like a few years from now.
Well, so this is the original note, right? So especially if there's a second mortgage, sometimes those will be interest only until the last 5 or 10 years, and then the payment jumps up to an amortized payment. So that we want to know that that's going to happen. I think what you're thinking about is mortgage statements.
Right.
A good agent will require that the mortgage statement be sent monthly to the escrow company so they can see if any payment changes. Good question. By the way, is this good information?
Yes.
Okay, so we've gone over everything on that one. Final thoughts. I teach an assumptions class, which is the other really amazing thing for agents right now, seller finance and assumptions. I don't know if any of you guys read that Wall Street Journal article that said the hottest thing in real estate is a mortgage from 2 years ago, but it talked about both of those, right? So imagine if you were buying your house right now and you understood that you could go buy a property on seller financing on a contract for deed, pay out the seller's equity, then assume their 3.5% interest rate with only 20 years left to pay on it. Would that be favorable?
Yeah.
Yeah, come to the class, there's a chat. But if it is an FHA or VA loan and the buyer is going to be occupying the property, I would select the requirement that the seller will participate with the buyer assuming that loan. Why not? Right? Why would you pay off $350,000 at 3.5% to pick it back up at 7%? Why? And by the way, that new loan is going to be over 30 years. When you do an assumption, you get to pick up where the buyer was at in their amortization. And when do you pay the most interest on a loan? Yeah, so you could save your buyers tens of thousands of dollars. Now, if you're marketing, that could be a huge thing. And then this one I put in just because I've seen it cause problems. You always want the sellers to owe less to the bank than their buyers owe to the sellers. Can anyone tell me why?
Can you read the question again?
Yes, you always want the sellers to owe less to the bank than the buyers owe to the sellers.
Yeah.
Why?
Because we wanna make sure that-
Yeah. Because if the seller's upside down and they've already got their money, they may not care. Right? So you want to make sure that that's in place. And that's why I put it in, because that should always be in place. And then this just explains that under a contract for deed, the actual transfer of title will take place later. Now, this is usually where I ask, who's confused about the fact that you transfer ownership under the contract for deed without transferring title? Okay, great. I'm glad some people raised their hands. So the easiest way for most people to think about it is in the context of an automobile loan from the bank. Auto financing actually took this from real property because it's a good model. So if I go and I buy a car and I get a loan from Wells Fargo, who owns the car? There you go. I do. But who holds the title? Right. Wells Fargo cannot come drive my car. They don't need to insure my car. They can't refinance my car. They can't sell my car. I can do all of those. Right? And they're not liable. That's true. That's one of the reasons I generally don't sell on a lease option, is because I want to transfer the liabilities of ownership to the buyer. So that if there is a leak that I don't know about, if the kids are sick and I get a lawsuit, it's not to me because I wasn't the owner. But yes, so under a contract for deed, ownership transfers. The buyer now legally owns the property. They're not on title. Can they refinance? Yes. We've closed hundreds of refinances where the buyer's not on title. Can they sell the property? Yes, because they own it. Just like the car analogy. Yes, title transfers once it's paid off. Now, there's the opposite of that. There's where you transfer title but not ownership. Let me give you some examples. If I forge a deed to your house, I only transfer title. I don't transfer ownership. That makes sense, right? I shouldn't be the owner if I committed a criminal act. Let me give you another one that happens in seller financing. Now, I know you guys think that most of the things on the internet are true. Sometimes you'll see people, and it just astounds me that this is still going on. They'll do an all-inclusive, but say, we're going to put a deed in escrow, and if the buyer's late, we're going to record the deed back to the seller. Let me tell you why that's incredibly dangerous. It only transfers title, which means the judge is going to give title back to the buyer and damages against the seller and any agents involved or title companies in doing that. And now the seller is going to be forced to do a judicial foreclosure, which is an actual lawsuit. One of the things you do not want to have if you're suing somebody is unclean hands. It's called the doctrine of unclean hands. It means you did something wrong and I did something wrong, therefore neither one of us should be held responsible. And you, as a seller, if you did what I just described, have definitely done something wrong. So it's not a good way to do it. Like if you ever hear or get an offer that's like the deed and escrow thing, run, don't walk, right? Away from that offer. Recounter with something that might work. Okay. I love this. We're gonna have time to actually go through everything I want to go through. The buyer has to comply with laws and HOA ordinances. That protects the seller. And then if the property is returned, it needs to be in as good or better condition. Yes,
So if on the HOA you have a assessment, like $20,000 assessment, whatever.
Yeah.
That is the owner, the new owner, right, the buyer?
Yeah.
But what about if you do a lease option?
it's technically the liability of the seller. Right? Yeah. Good question. Okay. We're going to move on. Now, I've been teasing you and saying there was one slide that ruled all the rest. Most important, this is it. This is the one that if you've taken no other notes, I would turn to the back of your package and you will see something that looks like this. It's under 3 circles. We'll get to the circles. We're gonna have strong core, months, legal, and down payment. Strong core is going to be, who is this contract specifically strong for? Is it strong for a buyer, or is it strong for a seller? You need to understand that at a fundamental level to do this correctly. Months is going to be how many months does the default process take? These are going to be minimums. Legal is going to be the cost of the default process. Those are also going to be minimums. Why? Because we can't project maximums. And then the down payment is going to be what we typically see as a down payment for each one. The seller is taking the same major risk in all 3 of these, which is that the buyer might not make the payment or might damage the property. So you want to compensate them as much as possible for that risk. So I'm going to ask you, the first things we're going to write down are some of the different types of seller financing. You can tell me some. Excellent. Lease option. Contract for deed. Beautiful.
All inclusive.
All inclusive. Now you notice all inclusive has a slash and then trust deed. That's because if it's paid off and you're just doing a trust deed, it's exactly the same risk and foreclosure process. You'll notice I do not have mortgage up there as an option. That's not because you can't do a mortgage, it's just because you would be very unintelligent to do so as a seller. With a mortgage, you have to do a judicial foreclosure. You can't do a non-judicial foreclosure. Those are a lot more expensive, a lot more time. Yes.
Do you know if there's a couple extra of these boards? I don't appear to have them.
Yeah. I don't
Anyone
know.
see an extra one nearby? That was page counter.
There's some up there, these stairs.
Okay. Cool.
Yep.
So you- Thank you for being a gentleman. All right, so lease option, contract for deed, and all inclusive. Now this is where it gets fun, because everyone's going to answer. And the reason they're all going to answer is because I'll see you not answer and I'll call you out like individuals. But the other thing is, if you proudly shout out the wrong answer, you will never forget the right answer. I can promise you. So, okay, so everyone, like seriously, I'll call you out. Everyone shout out. Even if you have no clue, you have a 50% shot. Or seller. Those are the 2 answers. So lease option. Who owns the property? Seller. Who's on title? Very back, you didn't answer. Thank you. So who's that strong to? You don't believe me, think about the house you live in right now and the fact that I can have you out of there within 4 to 6 weeks, right? That's lease option. Now, lease options are not bad. They can be very useful. I've actually had clients, in fact, this was a really cool phone call. I had somebody that had an option on a property in West Valley for a little over $300,000, which was now worth close to $500,000. They had called the seller and said, can we stay until our daughter graduates high school? The seller said no. They called me and said, can you force them to? I said, I've got you one better. I will make it so you can stay in the property the next 6 months for free. Assign me your option. Were they happy? Absolutely. Was I happy?
Yeah.
Absolutely, right? So options can be really cool. But if you default, you're done, right? As a buyer, it's a very weak position. Months, like I said, 4 to 6 weeks. So we tell people 2 months. just so that they're like really happy when we do it in 4 to 6 weeks. Minimum legal costs are gonna be $500. That's for the first scary attorney letter saying you've got 3 days to pay or get out. By the way, there are 2 types of eviction notices. If you're gonna do anything where you own property or you're representing clients as a property manager, you need to understand this. Sometimes you have a client that's been a good renter or a good lease optioneer, so lease optionee. And you want them to stay, but they didn't pay. You would do a 3-day pay or quit. But let's say they've been a royal pain in the butt. You don't care if they've got the payment or not. You just want them out. Then you do a 5-day notice to vacate. The difference is not 2 days. The difference is if you do the 5-day, they doesn't matter if they pay or not, they're out. Everyone get that?
Yeah.
Okay.
Your quit.
Pay or quit is a 3-day.
3-day.
Notice to vacate is a 5-day. And I've used both. And then the down payment is typically going to be less than 5%. We generally don't see large down payments on lease options. So let's go to the other end of the spectrum. Again, everyone has to answer. All inclusive, who's on title?
Buyer.
Love we have a little section there. Yes, buyer. Buyer is on title. Who owns the property? Buyer. Excellent. So who's that gonna be strong? The buyer, right? So let's go over the total timeline on average that I see that it takes to do a foreclosure. Now, if you want the simple answer, it's 4 months. 4 months is the foreclosure timeline in Utah. However, you have weekends, holidays, lazy attorneys, and this is the last part. It generally is going to take longer than just 4 months, but that's the minimum time. The reason I say 7 months is because on top of that, you probably have to do the eviction. And people in Utah don't start their default remedies when they should. Which I used to make fun of. And then I've been in situations where I was the person making the decision and the husband had just left and it was a bad situation. And I just was like, you know what, they don't have to make this one. Right? So as an attorney, I'd probably be kicking myself. But for your clients, it's not that they shouldn't be human. It's that they should enforce the contract. Because I guarantee the buyers will enforce the contract against the sellers. But usually by the time they start the process and finish the process and do the eviction, we're looking at 7 months. So that can be a big deal, right? If the seller's underlying payment is $3,500 a month, you've got to have a significant down payment to cover that risk. Now you understand why you don't do an all-inclusive and the buyer's putting down 10 grand, unless I'm your buyer. That's okay then. Other than that, no. So your legal costs are a lot more as well. You're going to have at least $2,500 in legal fees to do a private party foreclosure. But the down payments are generally very large, 20–30%. So those are great, right? Because that's definitely enough money to pay the agent, which I hate to say it, but you need to make sure that's there. Because 5 is not greater than 6, but 10 is 20–30. Those are more than 6%. All right, so let's talk about the contract for deed. Ready? Who owns the property? Buyer. Buyer. Love the fact we had some people say seller. Buyer owns the property. Who's on title? Seller. You guys are now seller finance experts. You can put that on the back of your card. You look, compared to most agents, wouldn't you agree with me? Yes. Somebody makes a seller finance offer to you, you are not going to play ostrich. You're going to know what to do. All right, so strangely enough, that can make it strong for both, right? This is the only one where you can negotiate how long the forfeiture takes. We did one this week, and they did a 60-day versus a 30-day forfeiture. But generally, the forfeiture process on a contract for deed is a 30-day process, 1 month. So when you add the eviction on top, it would come up to a total of 3. All right, so who besides me suffered through a college level math class? Excellent. Would you answer this question? What is the difference between those two numbers? Well, you are a genius. Yes.
I know them.
Now, why do I point that out? So that you and your clients can understand that I'm getting 10 to 20% down on a contract for deed versus maybe a few $1,000s. In fact, you guys have probably had a client, if you've done this long enough, that has said, I can't sell my house for how much I want to. I guess I'm just gonna rent it out, right? That is the worst out of all of these. How do renters treat properties?
Garbage.
Right? Yeah. And your sellers, like, for some reason, that doesn't even cross their mind. But in these, they're the owners of the property. I've had buyers I've seen them, they've put over $100,000 in improvements into a property they were not on title in yet. George, you've done a bunch of those where you bought it on a loan and then you sold it to somebody. There's a difference between an owner's and a renter's mentality. Yeah. So again, huge advantages. That's why I generally always sell on a contract for deed, because I want that owner's mentality. I want them to take care of the property and I want a big down payment. What's my risk? Another 30 days. For me, that's an easy transition. Yes.
A question on the contract for deed. If the seller, if the buyer said they can refinance and they can sell the property, right? Do they need signatures or any kind of notice from the seller?
Great question. So we have the sellers execute a warranty deed that's held in escrow by the escrow company in case the seller disappears with something very. Pretty much 100%, though, we'll just have the seller come and sign a fresh deed. Follow up and say, hey, great news, buyer's paying you off. We like to do a fresh deed just because I'm a liability freak and it's a little bit safer for everyone, but it's completely legal to use that deed in escrow. Now, we also have the buyer sign a release of the notice of contract to protect the seller in case the buyer's disappear. It's really important to protect both sides. Yes.
I'm not entirely sure what my question is here, but along this line of people disappearing, what if there's a death on either side? How does that?
Great question. So the contracts are drafted to inure to the benefit of the heirs. So if just the wife did it, the husband still gets to live there. Obviously, you still got to make the payment. If husband and wife pass away, it's basically a per stirpes distribution as far as the benefits. So it would go first to the kids if they're old enough. If there aren't any kids, it would go up to the parents and then down from there. But I've seen one where they passed away and it wasn't an issue because that benefit does automatically transfer. Yes.
So I had a question. I know earlier they talked about the lease option and using some of that money to be able to help get the sellers into their next house, the 75%. So with the contract for deed, can they still take 75% from that?
So that's a great question. So now we're into graduate level seller financing. This is where you combine one with another, right? So generally, George is, by the way, I know I pointed out George, he doesn't actually walk on water, he more kind of skips across it. He's one of the few lenders I know that gets this, right? I've had people that are like, oh, I'll take it to my favorite lender. And then they're like, it didn't work. I'm like, that's so shocking. I don't understand why. But when you combine, it's called a hybrid lease option to contract for deed. If you get into actually needing to use that for your seller so that they can immediately qualify for another property, just call me. I'll walk you through it. George also knows how to make sure it sets up correctly so that the underwriters don't have an issue with it. It's a huge system. It is, right? Yeah, because you use the lease option, and the lease option is the only thing that's operative at the time the sellers go and get their loan. Once they get their loan, it automatically converts to the contract for deed. We still file the notice of contract with the county to protect the buyers. And if you're working with the right lender, it's a flawless way to do it. That used to be the big Achilles heel of seller financing, is those sellers couldn't qualify for both loans. This way, they can go by that.
So you don't disclose that you're gonna do in the contract for deed after the reception?
So we send like George's underwriters, they see the whole thing. But they know right now it's a lease option, so they can use the. Yeah, that's, and if I haven't made that clear, you never commit loan fraud, like, don't even tread on that. It's, this is,
I don't like
you know what, strangely enough, Wells Fargo is not horrible at the end transaction, like, they financed a new buyer that bought it off the contract for the buyer that wasn't on title. But some lenders, again, their heads will catch on fire, it's really ugly investing. But again, you guys got some stuff that usually other classes don't get, so. God, whoever asked that question on the back. All right, we didn't go over this. The legal costs are going to be at least $750 with the contract for deed. And again, that's to begin the process. But it's a fairly quick process. And like I said, you can actually negotiate as a buyer's agent, I want a 60-day forfeiture instead of a 30. I had one agent that bought their own house on seller financing contract for deed, and they negotiated a 6-month forfeiture process. You can't do that with the others, right? So case in point, there was an attorney, and I hate using air quotes, but I don't know how else to do it with this. They did a foreclosure on a paid off property in 3 weeks. Now, you guys may not be attorneys, but you should know that's not possible, right? The statute requires a 90-day redemption period followed by a 1-month notice of sale. 3 of that's going to be published in a newspaper, but the full 4 weeks is going to be an electronic registry document. So minimum total of 4 months. The problem was they created a situation where now nobody owned the house. There were 2 phantom interests, but nobody actually owned it. I knew how to fix that. So no one else could buy that house, but I bought that house. Do you want to know how much I paid for it? $137,000. That's like a third of the price. Yeah. And I fixed it and I sold. But you can't mess around with lease option and all inclusive. Those are done by statute. Contract for deed, you can negotiate that to make it kind of favorable for both. Attorney version of it. That's right. I just had to fix the ownership. Right.
Does any preference between, it looks like contract for deeds, your preference for all of this?
No, so if I'm selling, I want to sell on a contract for deed. When I'm buying, how do I want to buy? All inclusive. There's one exception to that. Does anyone know it besides George? If it is a government insured loan. So again, if you've written nothing else down, please write this down because some title companies don't know this and it could cost you your business. I actually spent the time to get the FHA regional office on the phone. I said, if I do a lease option over your loan, is it something that could be put me on the prohibited transactions? For those of you that don't know, every time a lender does a loan, they'll check with FHA. If you as an agent are on that list, the loan doesn't go through if your brokerage is on that list. Look, the loan officer, escrow officer, title company, anyone on that list, FHA will not fund that loan. So this one was okay, still a violation of the due on sale clause. This one can get you put on that list for life as an individual and your company for 1 to 5 years. So do not ever participate in a seller finance deal where they're doing exclusive over FHA. Yes.
I don't know if this is in your thing today or not, but one of the things I was interested in is the due on clause sale for just a regular, a regular loan. How do you put that triggering? They all have them.
They all have them.
So
It's levels of risk, right?
Okay.
A lease option, haven't even heard of one being public. So contract for deed at 25 years, I haven't seen. All inclusive, I have seen. Let me give you how it happens. About once a year, I will get this phone call from a very panicked agent. Jax, you've got to help me. Great, what's the problem? XYZ title company closed an all-inclusive over Utah housing loan that's FHA. I said, that's a really bad idea. Every time so far, we've reclosed it as a contract for deed. So the buyer maintains their ownership, but the seller's back on title. Now, a really cool thing happened on the one that happened earlier this year. Utah Housing, the guy was like, I'll try to move back in, and Utah Housing said, you don't actually have to move back in, we just wanted to make sure you're back up. I'd never heard that before. They're probably not gonna publish that, but that's what they told this individual. So, can you do it? Yes, but it's levels of risk. Like, if your seller is really paranoid about the due on sale clause, or it's FHA or Utah Housing, it's only going to be done as a contract for deed. Let's talk about conventional loans being done by a loan servicer. Servicing companies have to buy the rights to service the loan. So imagine that's your business, right? I just paid you $1,000. Now I'm making $100 a month. It takes me almost a year to recoup my investment. Now I'm making money. And I find out the due on sale clause has been violated. I have a choice. Do I want to keep making money or cut off that revenue source? What is the servicing company doing? They're not going to care. I actually had one, and this is another air quotes attorney, because it's a bone in. His daughter, this is one of Dustin's, had sold on seller financing. And then this investor resold it on seller financing. And the intelligent attorney father found out and was like, wrote a letter to the mortgage company. Did you know that this happened? And then when the daughter was like, Dad, I'm making money. This is a really good thing. Wrote another letter to the mortgage company. Actually, it is true, but just ignore it. It's like, so anyway, you would think, right? If ever there was going to be due on sale clause of the service, that would be it. They just ignored it. They sent out their form letter. Thank you. Thank you for letting us know.
Usually it's like they're getting their fingers.
They don't care, right? They're making grant programs will care, but for the
So
gen-
the lender doesn't ever go back to the servicer and say, hey, by the way, can you just do an audit of these accounts?
if you understood who the lender was, like it could be 1,000 different parts spread out over multiple trusts and investments.
Oh, gotcha.
So it's, the servicers are not the ones actually that can't even make, and what's funny to me is sometimes your sellers will be like, should I call my bank and ask? It's like, they can't say yes, they're just the servicer. So no, you shouldn't call your bank and ask. All right, yes.
This is not discussed. All inclusive interest. When the seller defaulted.
So if it's done right, the seller can't default. If it's done wrong, the seller can default. Let me explain.
What was the question?
What happens if the seller defaults on their loan? So you've got the bank, which will represent here, right? You've got, now this is going to be the seller. And then here's the buyer. The wrong way to do it is have the buyer send the money to the seller and the seller send it to the bank. Because guess what? Sometimes sellers get a check and they're like, money. I know what to do with money. I spend it. What's a better way to do that?
Escrow.
An escrow company. Yes, so we have the escrow company, buyer pays them. They pay the bank and then send the remainder to the seller. That is such a better way to do it. It also alleviates headaches for you guys. Because if you don't use them, like if you have a client that's like, I don't know if I should, you should kind of be like, really think that's a good idea. Because otherwise, like January 31st, you're gonna get a phone call. Hey, you're really good at math. I need to calculate the 1098 interest with some additional principal payments. I'll just send you everything. You guys can take care of it, right? The escrow companies. Great question. Okay, let us continue on. Before we do, any other questions on this? Yes.
Is there ever too big of a down payment? You ever,
No, but that is a good point. If you have a like 50% down
Yeah,
payment, I would do
right.
the all inclusive.
okay,
Okay.
yeah, could get someone says, hey, he owns 50% of it, in that title shift without.
So the ownership would still transfer, but can you take it back on a forfeiture? The answer is yes, but, and here's the but. And I don't know how else to explain this, but in Utah, the judiciary, if you're stupid, they'll punish you. But if you're really an idiot, they might protect you. Like, so if you put down 50% on a lease option, they're probably not gonna let a simple eviction process take care of that, right? They might kick it into a judicial foreclosure. So the way I draft the contract for deed, it takes care of that because it gives it, the buyer will sign a trust deed at closing that is given to the seller. And if the seller gets to a point where they're worried about that equity threshold, they can actually record title in the buyer's name, record the deed of trust, and do a non-judicial foreclosure. But if they're putting down that much and there's not an FHA loan, you probably are covering the risk of doing it all in place, for sure. Yeah.
This is. This could, you want to. If the owner is deed of trust and the buyer put a lot down. And then create the seller payment is higher than the buyer.
Oh, that's a great question. So his question, in case you didn't hear it, and I have run into this, is what if the buyer puts so much money down that their payment is less than the seller's payment? The way we've handled that is we've at closing, we drafted this into the rep sheet, but at closing, let's say the seller was gonna have to pay $100 a month. And so we would take that $100 a month for the entire term of the contract and put it in escrow with the escrow company. That way it was already there and the seller couldn't default. That's a really good question. I'm not saying I've seen them all, because sometimes we see really good stuff. But I have seen most things that happen in seller financing. All right, so in the time we have left, let's go over the money part. How do you guys make money doing this? Most of you are going to start with buyers because the buyers already know they need seller financing. They already know that they're in a position where this would be good for them. So how do you get buyers? Let's go through some ways. Yeah, talk face to face. That's a great one. My favorite one is lending partners. George, if I was to limit the question, how many buyers call you that have a down payment and could buy a seller financing property in a year's time? Like without all the additional caveats, what number would that be?
Percentage, it would have 10% down.
Well, sure, 10% down. Like,
You know, it's a lot more than people think. I mean, I don't know if I don't know if it's half.
Yeah.
But there's tons of people that have money that they can put down, or they can get money to put down, which is the same thing.
Yeah.
You know, so I mean, it's at least half.
okay, so if at least half the people walking into a lender could be a client for you, do you think all of those people are qualifying for a loan right now? They're not. So when a lender markets you, you need to make sure they walk out of your office understanding that you guys can do business. They just need to send you those people. And when each one they send you, you'll send them somebody back. Like it's a really cool way to do business. It's the way I love doing business. I send George referrals, I send realtors referrals because that's a much easier way to market than just we got great cards and here's some more calories. All right, another one, short sales. Where there is low or no equity, seller financing is a great way to do it. It might shock you to know that in the past 6 months, I've had phone calls from people that were like, this is a short sale scenario because by the time they pay the agents and everyone else, and they happen to buy right before rates went up, they're gonna have to bring money into closing. We redid it as a seller financing deal and the sellers walked away with money instead of bringing money. And they're making money monthly. So that's a source. If you could find those sellers, you could get all those deals. TSL and internet marketing. A lot of agents, when they get a seller finance listing, they're like, cool, I'm going to do a deal. And they don't understand that that is the bait that you use to catch all of your buyer fish with. Right? I've got an agent that came to the class and she had a great idea. She's like, I'll get written permission from other agent sellers to market their properties as seller financing. And any offers that come in, I'll just send them on to the agent. And they've got over 2,000 buyers in their buyer pool because there are a lot of people that are interested. So use your listings to generate buyers and use non-MLS sources to do so. Right? If you're doing marketing to the general public, make sure this is part of it. Other agents is a great one. If you guys have somebody on your team or in your agency talk to them and say, hey, here's some really cool things that I know how to do. If you have a seller that doesn't want to sell because their new payment is going to be twice what their old payment was because of the interest rate, I can show them how to take the benefit of their current interest rate with. Everyone know how to do that now? No?
Yes.
Yeah. If not, talk to me later, we'll go over, it. But you can do that. And then guess what? The guy that does the most of these will not let me teach this at his brokerage. You want to know why? Because the agents bring him work, he gets half the commission, and all he does is email it to me. Like it's anyway. But talk to them because they'll have these people, they'll have buyers that are like, I've got a down payment, I just can't get a loan. They'll have sellers that are like, yeah, I would list, but I don't want to lose my interest rate. And get half that commission just for knowing the information. It's a really cool thing to do. Past clients, if you market to your sphere of influence, make sure you're sending something out saying, want to know how to take your interest rate with you to your next property? Call me. And then really small print asterisks, take the benefit of your, right? That generates the phone call, that generates the conversation. So past clients is a really good one. And maybe one or all of these is going to make sense to you and how you market, but hopefully you'll do something because it's funny. The agents that do something, they always close a deal. Always. And the next year, I guarantee you, if you just do this stuff, you'll close a lot of deals. And you may be like Raquel and be like, yeah, this is my 12th one. I still don't know what I'm doing.
But they're closing.
Investors, if you're working with investors, they should love this right now. Like I've never seen a better market for seller financing in my entire life. Large corporations, I'll share a great story about that. Corporations, we've got a lot of big ones that have come in, especially on the Silicon Slopes, and they're moving people from other states to Utah. And those people probably have not been able to sell their big house on the coast yet. But they may have a couple $100 grand in their pocket and they want to be homeowners. We had one where that was the situation, and this agent went into a company and explained that they could help those people buy houses now and got that work, even though the company had an in-house agent. That's pretty cool, getting referrals from the big companies. Business owners, it's a lot easier to buy on seller finance if you're self-employed than at the bank. By the way, anyone in here self-employed? But it is so much easier. Like I seriously hope to never get a bank loan again. That's not true because on my paid off properties, I'll get a commercial credit line so that money's available without paying interest on it while I don't use it. And then listings, again, use your listings to get buyers, like market to everyone, especially if you have access to an immigrant group. It is a very, very powerful thing to help those people. Now, I love those groups. And the reason I'll never be president is because my philosophy on immigration is, if you want to come here and work hard, well, if you're 30 years old or older, still playing video games on your parents' couch, you should be at work. Like, that's how it should be. Hopefully my kids are not pushing. Listings are a great way to get buyers. You've got to use that, right? Use it. In fact, I'll tell you a really cool listing story. We had a guy that he would put on KSL, he wouldn't get the property address, but he put, 5-bedroom, 3-bath house in Sandy, seller financing available. I specialize in non-bank financing contract for deed. And he'd do that because nobody knew what a contract for deed was. He got a call, he said he gets calls from buyers, from other agents. We got a call from a seller this time. It was like, what is that? He explained what it was and how it worked. And they said, I want to sell my house out. Then they disclosed that it had been on the market for over a year with another agent and hadn't sold. And they've been dropping the price and it hadn't worked. So my agent said, I can't help you if you're already represented. And so she went and talked to her initial agent and said, hey, what do you think about this? What the agent said?
Split the commission.
That's what I would have said. No, the agent said, oh, seller financing, I don't do that. He can handle this.
Wow.
So again, this is a big commission. Do you know how long it took my agent to sell the property after raising it back up to the initial price? 8 days. The offer they accepted, $300,000 down. Backup offer was $150,000. You want to hear the rest of the story?
Yeah.
Okay. So he goes, he gets both sides of that commission, double sides. Fortunate for him, unfortunate for the buyer. A few months after the buyer moved in, buyer's wife kicked him out and moved in her boyfriend. In retribution, the buyer stopped making the payment and the seller took the property back. Then the agent resold it for the $150,000 backup offer. So he only got half the commission. In the meantime, he'd taken the seller and gotten another property with her. And the initial buyer, who got kicked out by his now ex-wife, listed the $2 million Park City property they had with the seller finance agent because they understood how. Like that was just one deal. Because they put, I specialize in non-bank financing contract for need on KSL, and somebody called and said, what is that? Right? So use your listings to get buyers. You build that buyer pool, and then it's really cool. Guess what you do with your buyer pool? You can use that to get listings. You can go to expireds or for sale by owners and say, I have 10 buyers. One of them has 80 grand down, one of them has 60 grand down. I would love to show them your house. Can I do that? Yep. Well, you got to sign here for me to do that. Like, it's a great way to do it.
Is there a price point where these work best? I mean, like, are they good for all ranges of homes? I'm sorry if I.
No, that's a great question. My experience is the higher the price point, the easier it is to do seller finance. The more emotionally tied the people are to the issue, to the house, the more resistance there sometimes is. But if they've gotten to the point in life where the house is another asset, they want to maximize the value of it, it's really easy. All right, and then the final thing is 7 referrals. The average person you help is going to know 7 people in a similar circumstance. Like I said, it's just a river. It's funny. The agents that start getting buyers get more and more and more buyers because people talk to their friends and say, hey, this person actually can do it. It's pretty cool. All right, so you're going to start with buyers. Oftentimes, you're going to need somebody to fix their credit if that's the issue. So work with the lender that can coach them through that. And then use your buyers to get listings. The listings will create new buyers, but always start with the final closing in mind, right? Now, I'll tell you two ways to do it. One is your buyers just filed bankruptcy and had a foreclosure, and you put them in a 2-year term. George, are they going to be able to refinance? No. That's the wrong way to do it, right? So you want a lending partner that can tell you how long it needs to be time-wise. But on the flip side, I'll tell you a really cool story. We had an agent that did put a buyer that could not get a loan into a 2-year timeline because, again, this was a Spanish group, and they all had a different trade. Like one did drywall, one did electrical, one did plumbing. They had buddies that did everything else. They went and they bought an absolute dog of a property on seller financing with a 2-year term. And they fixed it up and they sold it. And with the money they made off of that, they went and bought 2 more properties. One of them had a 30-year term, so they lived in it. The other one, they fixed up and they sold and they bought 2 more. Like that to me is really cool. You're taking a family that could never own a house, and now they're at a point they can pay cash for a house if they want. Like it's really awesome to watch. But if your client's idea is they're going to stay in the property, make sure that it's drafted in such a way that it'll be successful. Now, if you're one of those people that doesn't get it, like if you're like contract for what, all inclusive view, I don't understand. That's okay. You know how to market, you know how to talk to people, use it, and you'll be successful. You are welcome to leave because we are exactly. But if you do get it, like if something made sense today, take advantage of this market. There's a reason why, like upstairs, we're busier than we were 2 years ago. It's because there is a huge demand in the market for seller financing. Most of your SOI doesn't know that they can use it. So reach out to them. You'll be very successful. Now, if you just don't do it, you're like, Jimmy John's was awesome. That was entertaining. Dave should have his own talk show. I get that. But this, learn the script, and this was meant to be funny initially, right? You like prize with that. And then, like, I started teaching this class before 2000. And in 2008, you guys all know something really bad happened for the average agent, right? Or loan officer. And 2 years later, less than half the agents that were licensed in 2008 were still licensed. So they had to learn a new script. But if you understand this and you use it, you actually like open your mouth about it. You're gonna be like George, Dave, and I. Like 2 years ago, we were hoping for today. Everyone else was hoping that the easy fruit times would never end. Because we knew we could do all the business nobody else could, because we knew this. All right. We'll see you guys in the future classes. Reach out to Dave for his. Was that a good class?
Yeah, very good.
Again, I'm like one of the only attorneys on the planet that has had a class. But here's, if you didn't put this in your phone, take a picture or put it in. If you're really smart, you'll go back and put in like Jax Pettey. Because then in 2 years, when you've got one, you're like, who was that guy? You just look up seller financing. George, thanks again for being here. If you have questions afterwards, I'm here. I will. Yes. Yes. That's great.
Thank you.
So you recorded?
Yeah, I recorded it now, make sure to send it out to you.
Oh, so, do you have any, those, after that?
You mean
The-
this one? The counter.
Yeah.
And you got my two jokes.
Your notes.
The hot dog and SpongeBob.
I remember you told me a lot of jokes, but I don't think I remember all of the answers, unfortunately. But you should tell me again. and I'll-
What comes first, chicken or the egg?
What?
When you're hungry, that's what I-
Oh, it's like 135. But I said, I do it.
Why was the chicken afraid of crossing the road? You can see on the other side.
Have a good one, and thanks for coming.
Thanks for the pass.
You bet. I'll let you know about the next one. Very, definitely use them a lot, so.
6%.
Yeah.
But the seller finance, it's the same level. Goes like 2 years ago. Where I